Hello, and thank you for joining us today for Bloor Street Capital's Battery Metals Conference. After being up 140% in 2022, lithium is down 60% in 2023, and many lithium stocks are down 50% or more on the year, creating huge opportunities for the coming year. Albemarle and SQM, the world's two largest lithium producers, are taking advantage of the pullback and have made investments in or have acquired other lithium developers and explorers. The demand for lithium will only grow, driven by the stratospheric growth in EVs, having gone from just 3 million in 2020 to 10 million in 2022. Fastmarkets are projecting sales of 14 to 15 million EVs for 2023. So where are lithium prices going in 2024, and is the pullback buying opportunity? To answer these questions, we put together a list of amazing speakers, from John Ciampaglia of Sprott Asset Management, followed by Phoebe O'Hara of Fastmarkets, Mac Whale of Cormark Securities, Keith Phillips of Piedmont Lithium, Robert Mintak of Standard Lithium, Chris Doornbos of E3 Lithium, and we conclude with Howard Klein of RK Equity. As a reminder, we have an open chat panel on the right-hand side of your screen. Ask questions, make a comment, or just say hello, and don't forget to subscribe to our channel, Bloor Street Capital. And you can follow us on Spotify as well as Apple Podcast. We hope you enjoy the conference. John, thank you for joining us today. Now, governments around the world are adopting net zero policies that have created opportunities for investors who are shifting away from fossil fuels. The adoption of electric vehicles continues to accelerate, and this is driving demand for many metals, including lithium. Now, Sprott offers products for investors to capitalize off this energy transition trend. Can you tell us a bit about them?
Yeah, we've definitely in the last 2.5 years noticed there is a growing trend amongst investors globally around playing this long-term thematic around energy transition. And the energy transition in our minds is really about generating cleaner energy from different technologies. It's about the transmission of that energy and electrification. And lastly, it's about energy storage, which is just another way of saying batteries, predominantly for electric vehicles. So the world is clearly focused on generating cleaner energy to decarbonize economies and lower greenhouse gas emissions, with the hope of achieving net zero targets out in 2050, which is all designed obviously to bring the Earth's temperature down. When we talk to investors, it's very clear they're starting to understand that this transition is going to be incredibly mineral intense. So it's very different than the fossil fuel based systems, which are more about liquids and gases. The energy transition will require a lot of minerals, and many of these minerals are critical in nature because they're not they're relatively new in terms of their development. I think lithium is the greatest example. It's a very nascent industry, and prior to the adoption of electric vehicles, we really didn't use lithium for a whole lot of things. So lithium is the one common element across every single battery chemistry for electric vehicles, and as a result, with the expected adoption of EVs over the coming decades, we will need substantially more lithium. And there is a real lithium race going on right now to secure the necessary supplies so that it doesn't become a bottleneck in the supply chain. So we think it's a multi-decade transition. It's not going to replace fossil fuels anytime soon, but I think the world, as it adds more energy capacity, is increasingly focused on making investments in cleaner technologies.
And you guys have 3 different products, the Energy Transition Materials ETF, the Lithium Miners ETF, and the Copper ETF. Can you talk to me about the interest you've seen among investors in these products and maybe the flows you're seeing into these products?
Yeah, sure. Well, ETFs, I think, are very popular vehicles for investors to get exposure to different thematics. And I think the reason is pretty simple. For the average investor, I think it's overwhelming for them to sit down and think about, okay, I like the long-term prospects of this particular metal. How do I go about investing in it? Do I pick 1 or 2 companies, or do I try to get exposure to the physical commodity if I can? Or do I buy a basket of different companies, all packaged up for me within an ETF, which is very easy to buy, low cost of ownership, very transparent. And that's really the path that we've taken with a number of our recent product offerings. We've taken our knowledge and expertise in metals and mining, And we've worked with different service providers, one of them being NASDAQ, their index group, where we basically work on the development of the investment universe, which is very important. What we find with a lot of investors is they want the pure play exposure to a thematic, and it's very hard for them sometimes to get it, because with a lot of these diversified mining companies, for example, you might think you're getting exposure, let's say, to copper, but in reality, most of the revenue at that company coming from iron ore or coal. So we really look company by company to figure out what is its role in this energy transition thematic, what exposures does it provide to investors. So we start with the investment universe, defining that to really become as pure play as possible. Second of all, we're constantly scanning the landscape for new companies, spin-offs, IPOs. Obviously, companies are changing their business mix and their strategies all the time. So when we develop our indexes, it's not a static process. Every 6 months, we basically look at the entire investment universe from scratch, try to figure out how these companies have changed, which companies have come and gone. We basically rebalance the index with new constituents. So it's a very dynamic process. And I think our expertise as active managers, integrating that into a passive approach and making it dynamic over time, I think is what investors are interested in from our suite of products.
For sure, and you guys have a lot of different metals to choose from, but I want to focus in on copper. You know, a traditional gas car uses about 50 pounds of copper, but an electric vehicle uses 150 pounds, and that's helped copper hang in relatively well this year. Sprott, as you said, has an ETF focused on copper. Can you walk us through that?
Yeah, copper, I think, is going to play a really large role in the energy transition for two reasons. One, it's really the backbone of electrification. So if the world wants to continue to electrify different, daily things that we use in our lives or industrial processes, transportation, copper is going to be a key part of energy generation as well as transportation. So copper, I think, is going to be the real backbone and workhorse of the energy transition. Copper, obviously, we've been mining for thousands of years. We understand copper. It's a very large market, almost $200 billion a year. But it needs to grow substantially over the next 20 years. We need to grow the copper production somewhere between, let's say, 50 and 80%, which is a pretty daunting task given how big the industry already is. And so what we've done at Sprott is designed the Sprott Junior Copper Miners ETF. The ticker on that is COPJ. It's really designed to give you exposure to a broad basket of companies that are smaller producers, emerging developers, and exploration companies. There's also been a lot of M&A activity in the space, and the reason for that is everyone is viewing copper as a strategic mineral now. Everything from the big diversified mining companies down to the traditional gold companies like Barrick Gold, which have been very open about their viewing copper as a strategic metal for the coming decades. So we've seen a lot of M&A activity in that space. I think the majors, if they find high quality projects in good jurisdictions, they're very keen to buy those projects and ultimately build them or expand them, then continue to develop new projects from scratch, given the very long lead times for some of these projects. So it's a very interesting way to gain exposure to the space.
Now, another component of the energy transition movement is nuclear energy. According to the World Nuclear Association, there are 440 nuclear reactors operating globally, with another 60 under construction, and this is driving demand for uranium. Sprott's most successful energy transition project is the Sprott Physical Uranium Trust product. A lot of retail investors follow you guys specifically for uranium. Why do you think that fund has been so successful?
Yeah, I mean, I was first start off by saying we totally embrace this idea that nuclear energy is part of the energy transition. We felt that way from day one. It's very reassuring that a number of governments around the world have publicly acknowledged a similar policy in the last couple of years as they are shifting back to nuclear energy for a few reasons. One, provides a very low carbon footprint. It provides incredibly reliable baseload power. And three, provides energy security. And unfortunately, in the last year and a half, we've learned what happens when a country does not have secure supply of its own energy. It is at the mercy of sometimes aggressive nations and weaponization of commodities. So the narrative and the perspective and the public support for nuclear energy has changed enormously since COP26, I would say, which is just 2 years ago. That is obviously attracting a lot of interest in uranium because it is the primary fuel that is going to power not just the existing fleet of nuclear reactors that you mentioned, but for the, let's call it another 150 reactors that are in different stages of construction and or planning. So we've got a very constructive long-term demand profile for uranium. Against that, we have a very large looming deficit of primary production of uranium because for so many years we had prices that were so low, companies were not incentivized to produce uranium. They weren't incentivized to develop their projects. They had no way of financing them. And so we've lost a lot of time with many new projects. So the industry right now is in the process of resetting itself. A big part of that reset is higher prices, which have allowed a lot of the mines on care and maintenance to come back online. So we've seen mines in Canada, Africa, Australia, the US slowly start to come back online, which is a really great outcome because it's helping a lot of these uranium mining companies. And you know, we don't think we're done. We think that even though the price has gone from the high 20s per pound to currently about $74 a pound, we still don't have incentive pricing to really build some of the key new mines that are scheduled to be built, we believe, in this cycle. So investors are attracted to that supply demand dynamic. And we think that even though the price has more than doubled in the last year and a half, that the price still needs to reach higher levels to really deal with this supply deficit that is going to really widen around 2030.
And we've seen a lot of wide divergence in performance this year between various metals. As we talked about, you know, uranium is in a bull market, but then if you look at lithium, it's down about 60%. What do you think is driving this divergence in the market, or what's your view on that?
Yeah, well, we have a very broad basket of different minerals and metals that are playing a role in this transition. And we've built our product suite to allow investors to pick and choose depending on where we are in the cycle. And every commodity has a different supply and demand fundamentals and is at a different spot in its cycle. Lithium, for example, in 2021 and 2022 was the best performing commodity in the world by far. It went parabolic. The price went from about 20,000 a metric ton all the way to 80,000 a metric ton. I think most market participants, including ourselves, did not feel that was sustainable because if you look at the cost structure of the industry, it's substantially lower than 80,000. And just a few years ago, lithium was at $15,000 a metric ton. So clearly there was a short-term bottleneck that created incredible pricing pressure on lithium. This year, we've had a pretty sharp reversal, as you mentioned. Lithium price is down substantially this year. I think that's really a function of it being a nascent industry. It's still trying to find its way. It's still maturing. You know, when you think about the copper industry, which has been operating for thousands of years, when you think about it, the lithium industry is very new. It's still going through its development phase. And I think that makes its supply profile very lumpy. It also, the demand side is also lumpy because EVs, while they've been growing at 35–40% in the last few years, they have slowed a little bit this year. I think part of that is because general economy has been softer around the world. Interest rates have gone up a lot. When you think about the cost of car ownership, financing is a key part. So you have seen a moderation in demand in terms of EVs. Now, are we going to grow still at 25 or 30%? Yeah, probably. It's not 40%, and so that expectation has clearly taken some of the energy out of the lithium price. But I think longer term, there are really great opportunities in the lithium space because of all the different minerals that we look at. It's the one that is going to have to grow the fastest in terms of new greenfield production. The M&A activity in the sector has been very good. it really reinforces to us that everyone is trying to get strategically positioned to secure the best assets. So they've got very robust pipelines of future production that they can sell to the OEMs. So yes, it's been bumpy, not totally unexpected given the meteoric rise of lithium in 21 and 22. It's going to find its footing. I think it's definitely basing here, and the price is still at a good level that the lithium companies can remain very profitable.
Interesting. Yeah, definitely a lot of geopolitical considerations to look out for when it comes to the energy transition. But right now, you guys are on the road marketing across North America and Europe your investment products to clients. Is the energy transition a major topic that they're bringing up? What questions are they asking you?
Yeah, we've been very busy, I would say, the last 2 years talking about this story. And we started off with uranium. It was really the beachhead for us in this broader category. And as we were talking to different funds, and I got to tell you, they were mostly in Europe. We were talking about uranium to funds, and I would ask them, what kind of fund do you run? Like, tell me a little bit about your strategy. And we would increasingly find we were stumbling into funds or sleeves or pods at hedge funds or whatever that were focused on energy transition. And sometimes they came from traditional energy backgrounds, meaning they used to be an oil and gas fund or traditional energy, or had a utility or infrastructure background. And they were starting to broaden their area of expertise to include not just uranium, but a whole host of different renewable energy technologies, as well as energy transition technologies and minerals. So it really started there, and it really got us thinking about, okay, this is much bigger than we originally thought. And I think a lot of investors they're looking at those signals and they're asking themselves, okay, if the world is starting to shift from a fossil fuel based system to a system that is going to be focused on cleaner technologies, and it's going to play out for the coming decades. This isn't a 1 or 2 year fad. This is a multi-decade investment. How do I take advantage of this? So we think more and more investors are starting to understand energy systems, how energy is produced, all the critical minerals that we rely on for many of these technologies. And I would say many investors are doing a lot of research in this space. They historically were invested basically downstream. So they were invested, as far as 15, 20 years ago, they were invested in solar and solar companies or solar manufacturing or wind. But now they're thinking about the upstream opportunity. Okay, if we're going to build all this downstream capacity, what do we need upstream? And the upstream opportunity, I think, is really compelling, because at the end of the day, you need these minerals to build all of this capacity downstream. So I would say there's definitely been a shift from upstream investments, from downstream to upstream investments, and that's where a lot of these discussions go around all the critical minerals that we're going to require. I would definitely also say that we're seeing a broadening of interest, particularly this year, where we're seeing more generalist investors reaching out to us that are interested in some of these thematics. They're just too hard to ignore. They're just becoming more and more mainstream. They're in the media every day. If you think about 5 years ago, owning an electric car, that was for a very privileged few. Now you've got electric cars where the price points are actually at the same points of gasoline engine cars. So the accessibility for an electric car has changed dramatically. It used to take us years to build 1 million electric cars. Now we're building 1 million a year. So we're seeing an acceleration. I think it's becoming more top of mind. I think younger generations of investors in particular are very interested in this, as they seem to be much more focused on climate change issues. They want to be part of the solution. So I think we've definitely seen a younger group of investors engage with us. We've seen a broader group of investors go, from specialty type of funds to more generalist funds. And because some of these industries and companies are still fairly small, we think we're still at the very early stages of this cycle. And there's going to be a lot of companies that are going to be big winners. There's going to be companies that are going to be losers. It's going to be volatile, and I think a lot of investors, because of that, are opting to just buy baskets of these stocks and riding the thematic. And I think that's where some of our ETFs have come into play.
Absolutely. And given the fact that we're still in the days of this cycle, do you think you guys will be launching more products within the energy transition space?
Yeah, I mean, we're constantly looking at obviously trends and how new technologies are being deployed. And we're looking at competitor offerings in the marketplace to see if they are in fact doing a good job of providing exposure to these minerals. And, we often find that they're constructed by, generalist kind of indexing shops and ETF sponsors that don't have any real expertise in metals and mining. And it's very easy for us to come up with something that we believe is more compelling because it's either giving you more pure play exposure or a more thoughtful way to index some of these strategies. So we're constantly looking on the horizon. I would say one of the themes for us in the next 12 months is going to be copper. We have a very long-term bullish view on copper. It's a very big market. I think institutional investors are going to gravitate to copper because it's very large, established, and liquid. Unlike some of these other metals, which are still earlier stage in their development, they're more volatile as a result. And copper is something that I think is just more understood by institutional investors. So we've definitely got a few things in our pipeline related to copper specifically.
Well, we look forward to seeing that come out the pipeline. John, thank you so much for spending time with us today and sharing your insights.
Yeah, thank you for having me. Nice to see you again.
Hi, Mac. Thank you very much for joining us today. You and your team spend much time analyzing the lithium industry, both from a supply and demand point of view and also from a valuation point of view. And this is where I want to spend most of our conversation. And I want to begin with a top-down or a macro approach on what's driving the lithium price. It's been very volatile this year. It traded as high as $80,000 a ton in late 2022. Now in 2023, it got as low as $20,000 a ton. And the equities, of course, have also been very volatile on the back of this. But why don't you just give us an overview of what's happening with the lithium price and why it's been so volatile this year?
Sure. Nice to be here. Thanks for having me. I think the number one focus that most people are looking at is the China price. That Chinese price is very much predicated on demand in China, and that is the market that has the biggest EV penetration. And so I would imagine most of your listeners will know that the Chinese economy is under a lot of pressure. There's a lot of concerns around what growth will look like. And so what we've seen in every one of these cycles, we see the EV penetration rate go up every single cycle and take away market share from internal combustion engines. Eventually, you're going to get to a point where those sales of EVs will perhaps also roll over in a downturn. It hasn't happened yet. A lot of people are concerned that this is now going to happen, at least in China. So that pressure on the economy in general is translating into worries over whether the supply chain itself is, say, oversupplied with material. And so you've seen inventories get depleted at the beginning part of the year when pricing was high, as you mentioned, $75,000, $80,000 a ton. Now we saw through the summer a small recovery in the price, and that was restocking from some of the using of that material as EV production started to ramp up in the third quarter. And now we're sitting in a situation where a lot of the trading houses are looking at a situation where demand might be weakening and inventories are high enough, and so the demand the demand now for new materials to fill that supply has weakened. So that's why we see the price now down around $30,000 a ton.
So that's a good overview. Let's move on now. I want to discuss your valuation methodology. How do you value lithium equities, and how is your approach different with producers versus developers versus explorers?
So when you look at the producers, there's only about 8 of them. If I go back to 2007 when I started covering a lot of these stocks, there was really only 2. The vast majority of material came out of basically 2 resources. Now we have 8 main producers, and they trade on different platforms. They trade on different markets, but they're also they actually have different mix exposure and different customer exposure. So when you actually dig into that, the only real proper way to compare them is just like as on an EV to EBITDA or price to cash flow basis. We choose EV to EBITDA. We like that metric for several different reasons. But when you look at how much material they produce and the price, I think that gives the most equal way of evaluating the various producers. So, we look back at the beginning of the year when the pricing was very high. These companies traded as a group closer to 7 to 10 times EV to EBITDA. Now they're down around 6 times, so as low as 4 times EV to EBITDA, which is quite remarkably low, given the fact that the EBITDA margin of all these companies is we just haven't seen it as high as it's been for the last 2 years. So it's a very funny dynamic. It's as if the market is saying, hey, producers, next year you could be facing a year in which your EBITDA is lower. And so you're getting a situation where if you're running an index, you're looking at that year over year change and it looks negative. Yet, if you're from a fundamental point of view as an analyst covering the stocks themselves, those are fantastic metrics on performance. It's just that they're lower than the year before. So that's what's impacting the multiple. When you look at a developer, you're in a situation where you don't have earnings, you don't have EBITDA, and you don't have exposure to the spot as it is today. So what we normally do is run a discounted cash flow on the actual free cash flow you're going to get from the project over time, and you're discounting that stream of cash flows, and you get an NPV, a net present value, and we just compare that to the market cap of the stock. So on those late stage developers, you're really just doing an NPV. So on an NPV basis, most of those developers, the more advanced ones, are trading at like 0.5 times NAV. So they're trading at 50% of the value of the project at a reasonable price. Those used to be 70, 80%. So they've come off a lot too. The third tier of companies that you have are the exploration companies or the early stage developers. They typically trade on like a enterprise value per tons of resource. So it's a metric I hate. And the reason I do is because it's basically just saying there's this much material in the ground, so the market cap ought to be this big. The problem is, in many cases, the economic value of to extract those resources from the ground can't even be realized economically. And so the EV, like a good example is a brine in which you pump on the resource and the brine doesn't even come to the surface. In such a situation, you tell me, how much do you think the resource is worth? It's basically worth zero. So to me, an EV per ton of resource is a poor metric that you shouldn't really use. I think you can be smarter than that. And what we do in our job is to run an NPV on that resource. So it's, I think, a much stronger methodology to use. And it gives you a narrower range of value when you look at the various companies. So to me, that's a better metric.
And Mac, what about the type of mining? Do hard rock miners in Australia have a different valuation or trade at a different valuation than a brine producer in South America?
Yes. So that's a great question. There's two things that are going on there. The hard rocks in general, if you go back, say, 10 years, there weren't really many hard rock plays. They were all brines. You had a few producers, and you had a bunch of TSX listed brine plays that were Argentina and Chile. And those traded at premiums because they actually produce chemicals. The output from a brine operation is lithium carbonate or lithium, in some cases hydroxide, but think of it as lithium chloride, but it's lithium carbonate, a chemical that goes into a battery. The hard rock mines effectively produce a concentrate, which then is sold to a chemical company. So you're not producing chemicals, you're producing an intermediary. So much lower CapEx, much quicker to get into production, but you're not producing a finished product. It's more of a commodity. So there's a difference between the CapEx intensity for those two types of businesses, and as a result, the return you would expect is actually different, and that translates to a different valuation. When you look in Australia, the Aussie listed stocks tend to be hard rock mining companies. So when you look at those, they also have a captive audience, where in Australia, the portfolio managers have to have a certain percentage that is invested in Australian listed stocks. That means they have a captive market for a relatively small number of stocks. So that's also inflated metrics. When you look at the Aussie listed names, they trade easily 20 to 30% higher, if not even greater, than the TSX listed names of the similar type of company. So you've got kind of jurisdictional distortions, but you also have a fundamental difference between the business of making lithium chemicals from a brine and making a concentrate from a hard rock mine.
Mac, one of the stocks you cover is Lithium Americas has been recently separated into two different equities. One asset will be focused on the Argentinian asset, and the other asset will be focused on the American assets, or Thacker Pass. Why don't you just take us through this company in terms of from a valuation point of view, but also from a risk point of view, and how each component has been separated, or how each component has been valued differently?
Yeah, it's an interesting example of a separation. We don't see these very often, where shareholders receive a share of each of the new companies. Excuse me. When we've seen that in the past, there's always a risk that one part of the business is more valued than another part, and that's exactly what we're seeing in this situation. LAC did several financings back when the Bureau of Land Management first approved the Thacker Pass project. That those financings obviously brought in a lot of US focused investors that wanted to have exposure to Thacker Pass, being in Nevada. However, the history of the company is actually in Argentina, where their Cauchari-Olaroz brine project is actually now in operation. So if all things were equal, a company or a project that's just about to enter into production, that would be more highly valued than a company that's in construction. However, Thacker Pass is being in the US, it has the US Inflation Reduction Act exposure, and it has a lot of potential for DOE loan support, whereas the brine operation in Argentina is exposed to country risk, also exposed to the spot price falling, unlike Thacker Pass, where it hasn't produced anything yet, so it's future pricing that you're looking at. And also has concerns around whether the company can bring cash flow out of Argentina, and at what cost would that cash flow come back to shareholders. So you have a completely different set of risks. One's operational and commodity price risk, but has country risk on the negative. On the other one, it's all about development of a project with all the risks associated with construction and ramp, but then it has all the positives associated with the US exposure. So it's a very interesting situation where shareholders get sort of an equal share in both companies. But what we don't fully understand, or it will be interesting to see how over time how these two different stocks actually trade, because prior to the separation, my valuation is $55 US per share, and we could easily see a very volatile period where it doesn't get necessarily split in two equal halves, and then it could take weeks for the trading to settle out to a sort of a final valuation for each segment.
And it is a very interesting situation, like you mentioned, because each asset kind of caters to a different risk parameter or a different type of investor depending on the risk profile.
That's right. If you're interested in So for instance, Lithium Americas bought Millennial and Arena, two other developers building projects in Argentina. So if you own those companies, you now own LAC, and now you now own LAC plus Thacker Pass as two separate entities. So the real question mark is, do those investors still want exposure to LAC, or do they want to monetize that investment through the investments that they made in Arena and Millennial? So there's a question mark there. Whereas if you're a US investor, clearly you don't have interest in the Argentinian assets at all, but you would have interest in holding onto Thacker Pass. So you've got you have at least three different sets of investors that have owned LAC over the years, that have bought it, and I just don't think there's a real understanding of the relative size of those. Now, of course, you've also have GM, which owns a big percentage of Lithium Americas now, and will clearly they'll have a hold on selling their Lithium Argentina stock, but clearly they're also not really aligned with the Argentinian project, right? So all that has to sort of play out in the relative valuation over the next probably 4 to 6 months.
Given the nature of your job, you speak with a lot of institutional investors, and I'm curious, with this pullback that we've seen in lithium down 50% or more, many equities are down 30, 40, 50%. Are you getting a lot of interest, a lot of inbound calls? Do you think people are getting more interested in the sector now because of this pullback?
So not yet. Like most of the concern most of the calls I get are about concerns about what various companies are doing relative to kind of what they said in the past they'd be doing, and like whether the projects are under some form of pressure given the pricing. Like that's where most of the concerns have been about. I think we typically don't see the new money come into a sector until there's a washout, like an absolute washout. And it's when you think about it, think about the marginal cost of capacity is probably $8,000 a ton. So lithium carbon equivalent. So some people will call me out on that. Like if you looked at some Chinese lepidolite producers, it's way higher than that, but let's keep them off to the side. But if you're a Western producer, there is some, the cost curve, it can go down quite low. So there's lots more room for the price to come down. So typically the new money comes in looking at these types of companies when you have an absolute washout in price. We're just not there yet. And I think the issue is we may not get there, right? Sure, we might be going down below $30,000 a ton, but there's a long way to go lower. And typically we don't see those new guys come in until there's a washout, and we're just not there yet.
Well, that was going to be my wrap-up question, Mac. Have we seen the bottom in lithium prices? And I guess you just answered it.
Well, it sort of did, but I could frame it a little bit more. When we see pricing, so I have a long-term price deck. My long-term pricing is $22,500 a ton. Some people have said, oh, that's way too low. But I think what's important to understand from the dynamics of supply and demand and incenting new supply, that might seem too low. The issue is when you model EV penetration, that can only happen when the battery price comes down. The cost of a battery in a car come down. That means the commodity prices have to come down. It means the capex for the new plants have to come down. Everything has to come down. So you will not get the penetration that you think if the pricing stays high, which means your demand won't be as high either. So these two things are connected. So you have to expect when you're building a new industry that price comes down over time. I think what we're seeing is different than that. Like that's not a smooth decline over a number of years. What we're seeing is a short-term inventory supply demand issue, and we've seen this before. And what happens is it'll overshoot to the downside and it'll come roaring right back. And I think that's what we're actually seeing. But it could take 6 months to play out. Whether it goes back to $80,000 a ton, I doubt it. But I do, and I think that's because the lepidolite starts turning on again. And so those are more in the $35 to $40 per ton range. So I think we're in a situation where we're going to see pricing come down, but we're going to we could quite easily imagine it going, bouncing right back up again. So it's a complex story. It's very volatile, which is a sign of that supply and demand imbalance that we should expect for the next decade, frankly.
Well, Mac, that was a great overview, and I want to thank you for spending time with us today and sharing your insights on what's happening within the lithium sector. Once again, thank you.
Great. My pleasure. Thanks for having me, James.
Hi, Keith. Thank you very much for joining us today. This has been a transformational year for Piedmont Lithium, having gone from an explorer co to a developer to a producer in a relatively short period of time. And Piedmont recently released its Q3 earnings, the first earnings in the history of the company. And why don't we just start right there? Give us a highlight of those numbers.
Thanks, Jimmy. It's great to be on with you again. It's always great to talk to you. Yeah, we were all thrilled at Piedmont to have our first quarterly earnings call and to report third quarter revenue for the first time. We had 2 shipments in the quarter. We had gross profit margins over 50% despite declining lithium prices, so we're very excited about that. Positive adjusted earnings per share of 88 cents a share. So it's great to have positive revenue, have positive gross profit and EBITDA, and positive earnings per share in our first quarter. So it's very exciting. We hope to have many more quarters like this and with higher earnings to come.
And as a reminder to our viewers, the production came from Sayona, which is a mine in Quebec, and Piedmont owns 12% of Sayona Mining and 25% of Sayona Quebec, and has an offtake agreement with NAL. Maybe you can just provide some background on that offtake agreement. How many tons does that provide to Piedmont, and what the floor and ceilings are in terms of pricing?
Yes, that's exactly right what you said. We got involved with Sayona a few years ago. We jointly acquired North American Lithium out of receivership. Sayona is the operator. Their team's doing a great job. So we put the asset back into production. As part of the negotiation, at the time, Sayona was looking for a customer for spodumene concentrate. We were looking to acquire spodumene concentrate for our downstream plans in the US. So we came together, we signed an offtake agreement. And essentially, we get the greater of 113,000 tons a year, or half of production, at market prices subject to floors and ceilings. 2023 is a startup year, so we agreed to treat this as a half year. So for 2023, we expect to ship 56,500 tons. And again, we'll buy that material at market prices subject to floors and ceilings. The floor is $500 US a ton, the ceiling is $900 a ton. Our realized price in this quarter was over $1,900. So we essentially acquired the material. And on a grade adjusted basis, the 900 is for 6% spodumene concentrate. We shipped 5.3% concentrate this quarter. So if you do the math, 5.3 divided by 6 times the 900 with some adjustments here and there, you get to our adjusted cost of around $805 a ton. Our selling price averaged $1,624 a ton. Thus the margin. So that's the nature of the deal. It's a life of mine agreement, and hopefully spodumene prices will remain high and it will remain profitable for us.
And remind me again, what is life of mine?
Life of mine is currently about 20 years, although you may have seen drill results out of North American Lithium in the last couple of weeks. It's a very big ore body. And this is an asset that was literally in production underground in the 1950s. So it's been around a long time. It's been worked on by different groups. It was put back into production about 12 years ago by a Lucas Lundin-backed group, actually. And we're just now, really doing the right things with it, investing the right amount of capital to make it operate most efficiently. And we've taken the opportunity with Sayona to really invest in drilling to understand the scale of the opportunity. And it turns out in the last week or two, Sayona announced drill results that are probably the best ever by far for this deposit. So the future could be bright. We think there's an opportunity for considerable resource and hopefully reserve upgrade. both in scale and in quality in terms of grade and thickness. So yeah, that's great news. That will require us to do some work on engineering. What does that mean from a mining perspective? Does that mean alterations to the mine plan down the road? Probably it does, but that's a good thing. And so we're excited about that. I think this is the sort of mine that could go for 50 years quite easily.
And I'm glad you brought up the drilling that's going on. So is this exploration drilling or infill drilling, and what's the purpose of it?
It's both. It's a good question. There was some drilling done by a prior owner that was deeper, that indicated some opportunities kind of at depth, which NAL had never really pursued previously. So that's exploration drilling that's going on. Those results are quite impressive. So very exciting. We're also doing a lot of infill drilling within the pit. As we got involved ourselves with Sayona over the last couple of years, we took a couple different looks at the resource model. So a lot of drilling is going on inside the pit shell to really understand, mining priorities, et cetera. And I think there's a lot of inferred resources that we think some of which will have an opportunity to come into the measured and indicated category and be ultimately counted as reserves.
And you mentioned earlier that Sayona started producing in March of this year. It is ramping up. Maybe you can just speak to the ramp up process, and when will it be at full capacity?
Yeah, it'll probably be at full capacity middle of next year. I mean, full capacity for the current resource that could change in time with higher grade material, et cetera. Fundamentally, the team's doing a great job. It's a brownfield asset, so it was relatively easy to get started up on the one hand. On the other hand, most of the material, the plant was built 12 or 14 years ago. It's been on care and maintenance. There've been some minor maintenance issues that are being kind of resolved, and there's continual upgrading to go. So they're producing well. Sayona put out guidance a couple weeks ago on kind of fiscal year production. Their fiscal year is June 30th of 140 to 160,000 tons of production. I think they indicated, and our sense is we'll be at full ramp up by the end of that fiscal year. So, mid to late next spring, which is great.
Why don't we move on now and discuss Ghana? Piedmont's next project to come online is in partnership with Atlantic Lithium, and the project is located in West Africa, or in the country of Ghana. And Piedmont also owns an offtake agreement with Atlantic Lithium. Maybe you can just provide some details of that offtake agreement and what it means to Piedmont, and maybe how things are progressing within Ghana.
Yeah, things are progressing really well in Ghana. So our offtake agreement there is different. It's similar in that it's basically 50% of the material. It's not the greater of, but it's 50% of material produced. It's at market prices, no floors or ceilings. So it's a market-based offtake agreement. What it does is it gives us 170,000 plus tons a year of spodumene concentrate that we can have committed to us to bring into our downstream plans, principally in the United States. So that's great. Important achievements in Ghana this year were, first of all, there was an announcement in early September. I was in Perth with the team when this was announced, of MIF, the Sovereign Wealth Fund for Ghana, investing in the project. They're investing about 28 million to buy 6% of the project. They'll fund their share of the CapEx. That's a great endorsement, very important for the project. Separately, the mining lease was granted a couple weeks ago to Atlantic. That needs parliamentary ratification, but we expect that to be forthcoming. So we're now entering the permitting process. It should be relatively straightforward. Ghana is a proven mining country. This is a simple DMS plant. So we hope to be permitted by late 2024 and then start construction and be with production commencing kind of late 2025 and ramping up into 2026. And what I'd highlight here is this is a big project. If you look at Atlantic Lithium's PowerPoint, they characterize this as the 10th biggest spodumene producer in the world, 10th biggest producing spodumene mine in the world by the time it's ramped up in 2026. So that's exciting. We're going to own essentially half of it with some dilution with the government involved, and we'll have half the material. So it's very significant. It should be relatively low CapEx, relatively low operating costs, just given the nature of the flow sheet. And it's a truly world-class project. Interestingly, we can get material physically from that mine site to our chemical plant site in Tennessee for less money logistically than it would cost to get it from Val-d'Or. That's how attractive kind of the shipping logistics are from the port in Ghana to our site in Tennessee.
Keith, you mentioned Tennessee. Why don't we move the discussion toward your U.S. operations and give us an overview of what's happening in Tennessee? You have all the permits in place. If you wanted, you could start construction very soon, but you're going to hold off. Why?
We really want to put in the most sensible financing package for our shareholders. So this is a big project. The definitive feasibility study showed CapEx about $800 million. We've done a lot of detailed engineering since then. We spent a lot of money on the right consultants doing the right work. And with just capital cost inflation, it's clear it'll cost some more. We don't know exactly how much more yet, but as we think about funding it, it's a big project. It will be harder to execute, I think, given the history of some of the projects, say in Western Australia, than a spodumene mine will be. So from our perspective, we think it's important to de-risk it technically and financially. So we're applying for an ATVM loan through the Department of Energy's Loan Programs Office. These are the low-cost loans that are put in place for EV businesses and suppliers to EV businesses like us, essentially. We think that could cover somewhere around 70% of the capital. And for the rest of the capital, we're in conversations with potential strategic partners who would like to get involved in the project. We're willing to sell down as much as half of the project, end up owning half. We'd like to own more, but we're happy to own half with the right partner. I would say interest is strong, as you might suspect. It's early days. It'll take several months to bring a process to conclusion, but as you might imagine, a world-class lithium hydroxide plant in the southeastern US benefiting from the IRA in a market where we think we'll need 30 or 40 times more lithium hydroxide in the US than we currently produce just in the next decade. It's really very strategic for people. So the big car companies, the big battery companies, many others are quite interested. And we think we'll have a pretty happy outcome there and really end up with a project that we own half or more of for a relatively small amount of our own capital. We've already invested quite a bit ourselves with the technical execution de-risk considerably. So that's the way we're going to approach it. It's all about preserving shareholder wealth and not putting it at risk.
And when you talk about the announcement of a partnership, when can we expect to see that news? Will that be sometime in 2024?
It could be. It could easily be. I mean, I think the process could move quickly or slowly depending on how we pursue it. I mean, there are parties who are more acutely interested. There are some parties who we think this makes a lot of sense for, who we need to spend more time with. And we're not in a big hurry. I mean, there was this view in the lithium industry for a period that prices are at this extraordinary level. You should move as fast as you can to get into production. I never really bought into that strategy, and I certainly don't today with prices having fallen 70%. So I think what's important is to do it right. This is a 30-year asset. It's important to get the right partner socially, technically, financially, someone who the US government will embrace, obviously, and because that'll help with the funding and to really do it right. We're going to build a big lithium hydroxide business. Tennessee will probably be our first plant. Getting it right is really important to us. So 2024 timeline, sure, that should happen, could happen, but we'll have more news as we know the answer.
All very good points. The last project I want to touch on is Carolina Lithium, which is based in North Carolina. It's at the feasibility stage. Why don't you provide an update on this project?
Yeah, it's a great project. We call it the best located lithium project in the world. It's in North Carolina, 30 miles west of Charlotte on the tin spodumene belt, one of the world's biggest spodumene belts, and where all the lithium in the world was produced from the 1950s to the 1980s, essentially. So it's a great location, surrounded by customers, great labor force, low cost energy, great infrastructure, and importantly, an opportunity to monetize the byproducts from the mining process. Most spodumene pegmatites in the world have other minerals like quartz or feldspar associated with them, but they don't have markets nearby. We're surrounded by consumers for those markets. So that could be a very significant benefit to our cash cost of production on the mining side. So that's a project we're moving forward. We're in the permitting phase. We need a mine permit. We're in the late phases of that. We hope to get that in the first half of next year. We need an air permit for the chemical plant we're going to build. It's an integrated site with a mine and chemical plant on the same site. That's unique. There's nowhere else in the world other than possibly NAL where that's the case. So we need an air permit. We think we get sometime next summer. And then we need to have the property itself rezoned. This is a private land that we own, that we've acquired. It's currently zoned, for the most part, residential or agricultural. It needs to be rezoned for industrial purposes. That's a process that will follow the mining permit. So it'll all take time, but good things are worth waiting for, and we remain very confident we'll get to the finish line with that project. It's currently slotted to occur after Tennessee, so we'll see how this partnering process goes. Every partner, potential partner we're talking to is also interested in Carolina, as you might imagine. And so we'll see how that all plays out in 2024.
Keith, I want to move on and discuss your balance sheet and also your funding strategy. You have a lot going on, all of which is going to require a lot of capital. How much cash do you currently have on hand, and how will you allocate that cash in the coming year?
The answer to the second question is carefully. So we have about 95 million of cash in the balance sheet. We also own about 85 million in stock in Ciampaglia and Atlantic. Those aren't really held for sale. It's not our plan to sell them, but if we needed money, we could. Those shareholder interests are unrelated to our JV interests and our offtake arrangements. From a capital perspective, over the next year, we expect to generate operating cash flow through our NAL offtake agreement. We have a gross margin of 50% at these prices, so that's helpful. Most of the money we need to spend, you would expect to spend it, say, in Ghana, in Tennessee, and Carolina, is already spent on the engineering. The DFS is done in Ghana. Most of the remaining spend there will wait for a permit, which is a year away, plus or minus. A lot of work has been done on front-end engineering design in Tennessee. We're not going to do a lot more now while we go through the partnering process. Partners might have their own points of view on things, so we'll preserve capital there. And in Carolina, we're really just spending money on permitting, which isn't that expensive, but also acquiring some of the land still as it comes to. So we feel good about our position. We're fortunate. I mean, the big differentiator, I think, for us is, of the dozens and dozens and dozens, if not hundreds, of lithium projects and companies out there, we're one of a very small number that has cash flow, and that's a big differentiator. We're a producer with cash flow, and that really lets me sleep easier at night as I think about our cash position.
You'd made mention earlier about how the pullback in lithium prices has impacted your financials. Do you think we've found a level with the lithium price now, or do you think we might be under more pressure?
It's hard to know. I think we're certainly bumping up against the cost curve. I mean, this is a somewhat opaque industry. Maybe it's more than somewhat opaque. It's a young industry. The sources of raw material are, the biggest sources have been Australian spodumene, South American brine. It's been 80% plus of the market. As the market's grown, there've been some African spodumene projects come online. There's been some Chinese lepidolite projects come online. Not everyone has a great handle on what the operating costs of those operations are, but I think it's safe to say that as you think about lithium, and there are really three benchmark products. There's the mineral concentrate, spodumene concentrate that we're selling now, and then there are lithium salts, hydroxide and carbonate. And ultimately, to produce lithium carbonate or hydroxide from lepidolite, lepidolite's another mineral considerably lower grade than spodumene. By definition, operating costs are higher. You got to process a lot more rock to get to the same place. So I think we're bumping up against that cost curve. In our view, I mean, the benchmarks that we've been focused on with our own contracts, with our trading companies selling spodumene, we sort of plateaued here over the last few weeks. And I don't know if that's a false bottom or if that's a bottom forming. I don't know, but we don't have a great crystal ball heading into the next year or so. We're happy to have 50% gross margins at these levels. If prices would rebound, not to the historical levels, but if they would rebound, it would be great for us, obviously. Our costs are relatively fixed. We pay $900 a ton, adjusted for grade and some other minor things. So prices go up, we obviously, it's direct to the bottom line. And so that's very exciting for us.
Keith, as we wrap up, 2023 was a transformational year. Piedmont became a producer, and you also released your first ever earnings. How are you going to top that in 2024?
That's great question. I think the NAL operation will continue to improve. I think they will, we'll get to nameplate. We'll get to run rate by the middle of next year. I expect to see more drill results announced, and I think you'll see over the course of 2024 some discussion of what those drill results mean in terms of mine life, in terms of mine plan, and what the potential upside of the project is. So that's very exciting. We hope to have financing for Tennessee very much involved over the course of 2024. We hope to see Ghana permitted and in construction in 2024. We hope to see Carolina permitted and moving forward through the rezoning process in 2024. Those are all important catalysts. I think the market, we're a somewhat more difficult company to analyze, and I think many say that the value of our offtake agreement alone represents our market cap, and I think people have discounted assets like Carolina very, very heavily. And that's okay. It provides a lot of upside for us. And I think as we demonstrate success at a place like Carolina, and the other projects, I think the market will be able to focus on kind of the broader value proposition within Piedmont.
Well, it sounds like you and your team are going to be very busy in the coming year, and that was a great overview and a great update on Piedmont Lithium, and I want to thank you very much for spending time with us today, and I look forward to the next update.
Thanks a lot, Jimmy. Happy to do it.
Phoebe, thank you very much for joining us today. Before we begin, tell us about your firm, Fastmarkets. Where's the firm based and what services does it offer?
Thanks so much for having me, Jimmy. It's always great to be on your channel. So Fastmarkets, we're predominantly a price reporting agency, so pricing a whole string of commodities in a vast array of different industries. From my perspective, I'm on the battery raw materials team, and that's in a research team where we produce long-term forecasts looking out on the key battery metals and then all other aspects of the battery. So battery cost modeling, cost curve modeling, battery recycling, so end-to-end full analysis. And we pair that with our in-house editorial team who produce the global leading prices for lithium, nickel, cobalt. So really kind of a full spectrum of the battery world from top to bottom, and it's a really great place to be. And we just came off of our conference in Amsterdam where we discussed a lot of battery related content, which I'll probably bring up in the next 20 minutes or so.
And I'm glad you brought up that conference in Amsterdam. Maybe you can give us a little bit of context. What was the theme of the conference and how many people showed up?
Yeah, so it was our Europe Battery Raw Materials Conference, so very much based in the conversations around Europe's issues, how we tackle those issues, and the kind of facilitating cross-industry collaboration. So we had actors from across the supply chain, starting in the upstream with the likes of Albemarle, your global leading lithium producers, nickel producers, cobalt producers, down to the midstream processors, manufacturers, battery manufacturers as well, like your CATLs, and then down into the downstream, so Volvo, Mercedes, Daimler, the whole host of the people acting in the sphere were there. And yeah, we were discussing all the issues going on in Europe right now. So the complexities of regulation, the lack of upstream supply, these are all issues that we were touching on a long-term forecast. So it was great to kind of be able to engage with clients on that and try and get to the bottom of some of those issues.
And Phoebe, the big driver behind lithium demand is the growth in EVs, and 10 million EVs were sold globally in the year 2022. What is Fastmarkets projecting for EV sales in 2023?
Yeah, so last year was a great year. This year we're looking at 14.9 million EVs being sold. And that sounds like a great number, and it is. But if we look at year-on-year growth rates for this year compared to the last, we're expecting 32% year-on-year growth this year, which is a lot slower than 2022, which was around 54%, and the year prior in 2021, which was 104%. So continuing that kind of strong growth, but not at the same level as previously. And that's largely due to some kind of slowing momentum in China, where we've seen a real sluggishness in that market due to kind of a string of factors, mostly macroeconomic in nature, but also a real saturation of the market there with EVs and a lack of affordability for consumers in different regions of China. So there's some kind of structural issues there, which I'm sure we can go on to in more detail later in our conversation. But yeah, all in all, kind of we're seeing some cracks emerge, some structural issues that I think as an industry, we're trying to engage with and make sure that we can tackle further down the decade.
And when you talk about 10 million or 15 million EV sales, it sounds like a lot, but when you look at it as a percentage of overall sales of cars, what percentage would it be?
Yeah, so this year with 14.9 million EVs, that would be around 20% EV penetration, aka 20% of total vehicle sales. That would be up from 15% last year. So it's a fair amount. It's not a third as of yet, but I think we'll get there in the next couple of years. I think what's more indicative is if we look at EV penetration rates across different regions. So in China this year, for example, we're expecting it to reach 34% of EV penetration rate. Europe, we're expecting 30%. US 9%, bit of a more nascent market there, but fast emerging. And I think what those three regions highlight as the most fast moving, kind of largest consumer markets is that EVs are surging very quickly in consumers' minds as being a popular item to purchase. And secondly, what those numbers are also showcasing is that we're passing the tipping point for EVs being consumed. And we largely argue in the industry that that's a 5% EV penetration mark. And that's because if we look historically at markets that have been quick to emerge as countries for fast EV adoption, we see the 5% EV penetration mark as kind of the beginning of an S curve, so exponential growth. And that's mostly due to the fact that EVs are around more often, so consumers build in their confidence as them as a transport vehicle. But it's also that historically we've seen that EVs then move away from the niche kind of edge of the market and become very much more kind of consumed across different consumer types. So with all those regions surpassing that 5%, it's a really exciting time. And I think we're going to see exponential growth across a lot of different countries over the next 2 years.
And Phoebe, when it comes to adoption of EVs, one of the things that prevents me from acquiring one has to do with the range and also the lack of charging stations. And living in a cold climate, it does have a negative impact on the charge. EVs work very well in Florida or California, but not so well in a cold climate. So maybe you can just talk about that and how the lack of charging station in conjunction with a short range has negatively impacted the sale of or adoption of EVs.
Yeah, I think the biggest thing to highlight there is charging point infrastructure as the main barrier. Cell technological development is fast evolving, and I think that in terms of a range concern is not actually the problem. And I think that's the adjustment that needs to take place in people's minds. It's not range anxiety, it's charge anxiety. It's that fear, right, like you've just said, Jimmy, that you're not going to find a charging point in the rural areas of Canada where you go skiing, or in the rural areas of the UK where I am if I'm going on a trip somewhere. So really the issue there is ensuring that there's the right policy, the right incentives, and the right financial support to build that network. And what I included in my demonstration in Amsterdam was some kind of research I've done to show the countries in the world that are the most advanced and the least advanced in building that infrastructure. And we can do that by creating a simple EV fleet to charging point ratio. So what it showcases is that at the bottom of the pile, we have the US with a 49 EVs to 1 public charging point ratio, compared to your South Koreas or China, where they've got 2 to 1 and 3 to 1. And typically why that 49 to 1 is not that great is because we argue that a 10 to 1 ratio is kind of the basic necessity for 2 things to happen. Number one, to actively support your current fleet, but also to embolden people's confidence in the market to purchase an EV because they're around, they can see public charging points, and their charge anxiety reduces. So that's the kind of real fraction or fracture, should we say, right now in the market. I think that's the area where consumers have the least confidence, and that really needs to be ameliorated, because on the technological side for cells, that is quick advancing, and we're seeing, you know, cells coming out of China that have over 1,000 kilometers in range, for example, if we're referencing Goshen cells. So yeah, I think the charging point is a real sticking point for us right now.
And why don't you just expand on that? When it comes to lithium ion batteries, there's 2 primary types, NCM and LFP. What's the difference between the 2, and which one is more dominant and why?
Yeah, it's funny, these 2 kind of emerged as the kind of lead competitors in the market. If I just kind of explain the differences and why they're going head to head. So LFP, it's a lithium iron phosphate cell. Typically, it has a lower energy density because it can have around 150 to 170 watts per kilogram. And however, it's kind of a lower cost because it's lithium iron and phosphate. If we compare that to NCM, we're looking at nickel, cobalt, manganese. The inclusion of cobalt makes it a bit more expensive. However, that nickel and cobalt partnership gives it a bigger energy density with around 220 watts per kilogram. So that's kind of giving you a range of 400 to 600 kilometers. And so that range is making NCM far more popular in markets like the US, those in Europe. where consumers perceive a need to have a vehicle that can travel, you know, that's 600 kilometers. And by contrast, we're seeing LFP being manufactured and consumed in China quite a lot. So you're getting around, if we take kind of the Tesla Model 3 as an example, 430 kilometers of range, so a bit shorter. The thing that I think will change with time is that consumers will become aware that they actually don't need that much range in their vehicles. So research has shown that 99% of users in the UK actually use less than 160 kilometers in total drives kind of in a car in the year. And then the average trip in the US is in 94% of cases also below 80 kilometers. And I think that gives a sense actually as to the reality of the car that you need. And I think with time, consumers will realize that and be more comfortable with having an LFP battery in their car with a lower range as a result. But for now, if I just give you our forecast, in 2033, we're expecting NCM to be the more dominant in EVs with 48% of the market. LFP is going to have just a little bit below that with around 40%. But I think with time, LFP will kind of overgrow NCM as those changes in the consumer world kind of take place. So LFP in our minds is really where the growth rates is at, but NCM will still be around to play.
So we spent some time on EVs, but you have also done a lot of work on energy storage systems. What is energy storage and how is it driving battery demand?
Yeah, so to give a kind of broad definition, energy storage is where you use technology to store and harness energy from the grid, and then you expend it at another time when you need that energy. So historically, that's been done with hydropower, where you use water from different heights to propel a wheel and generate power. And hydropower has been around since the 19th century, so nothing really new there. But now we're in the era of battery energy storage. So that's where you use a battery to store energy from the grid and then expel it at another time for a variety of use cases. It could either be, the main ones are one of two. So the first is frequency regulation, where issues with the grid, they'll use batteries to store or expel energy to balance that out. And then secondly, and why we're seeing it become super popular, is the arrival of renewable energy. Renewable energy creates a lot of peaks and troughs in terms of power generation. And what batteries can do is they can store the energy at those kind of peak times and expend it at times when it's lower. So if you take solar, that would be at night. And we're also seeing markets kind of realize this and understand the capacities that batteries pose to their grids and their renewable energy. So if we take the US and China, we're seeing an explosion of policy, which is really seeking to increase the amount of batteries in their markets. So the US with the IRA, incredibly lucrative tax credits, reaching 70% of the tax credit for ESS products. And that's made investors really keen on pursuing ESS projects there. And then in China, we're seeing more of a stick than a carrot approach, enforcing that of all renewable energy products, 10 to 15% have to be supported by a battery. So policy really leading the way there, but also the private sector coming up with the likes of the IRA, creating the kind of lucrative nature of ESS. So a really exciting market. I would frame it all by saying, though, that it's only 7% of battery demand globally right now. It's going to reach 15% by 2033, but it is much smaller than the EV segment. So we'll still see that world, shall we say, kind of take the lion's share for battery demand.
Phoebe, we can't have a discussion on EVs and lithium-ion batteries without discussing China. And you touched on this earlier, but it is the largest market in the world. And maybe you can just tell us what's happening in China in terms of the economy and also the impact that is having on the growth in EVs and also lithium-ion batteries.
Yeah, I mean, we're all reading about it, right? There's a real change going on in the Chinese market. The history of growth and their economic model is starting to show signs of distress. And within that stress is the EV segment. So historically, you know, we've seen year-on-year growth rates of 100% and over. And this year, you know, we're seeing year-on-year growth on a monthly sense of around 30 to 40%. So it is slowing down. And if we take Q1, in January, we saw sales actually negatively contract by 5.5%. So a real sluggishness there. And as we've said, kind of due to macroeconomic factors, but also there's kind of a saturation of consumers who can afford EVs now, who bought them. We're actually seeing a rise in plug-in hybrids as a result, because those are people in more rural areas who are seeking an EV that works for them in their location. So there needs to be an improvement of charging there. And also, we're just not seeing the kind of growth rates because of the lack of affordability. More generally, China's consumer market is much more variable in terms of average monthly income, particularly in rural areas. So we need EVs to get a little bit cheaper as well. So we'll see that happen. But until then, the market is sluggish. And as a result, global sales are a bit slower. And as a result of that, lithium prices and lithium demand for this year is also a lot slower. So it's very much a China story.
So let's expand on that, and let's put all these two factors together. The EV adoption rate is growing, but we have an economic slowdown in China. What are these two factors, or I should say, how are these two factors impacting the lithium price?
Yeah, we've seen real sluggishness this year. So if I give you some figures using our Fastmarkets, LCE, so that's lithium carbonate price in China, we saw over 590,000 yuan per ton in price last December. We're now at 200,000. So, a drop of over, 70% there, which is pretty severe given the highs in Q4 last year. So what we've seen really, in addition to that volatility, is consolidation. And what I mean by that is this 200,000 euro per ton has really demonstrated to us where supply really is. Last year, there wasn't enough, and that's why the prices were so volatile in terms of upward trajectory. This year, China has kind of got overcapacity and oversupply across the supply chain. So I mean lithium, also batteries and EVs. And why that's showing in the lithium price is because that means that there's a lot in the market and we just aren't consuming enough of that stuff, essentially. And so what we're hearing from lepidolite producers is that they're actually starting to turn off the taps at 200,000 yuan per ton. And that signals to us that that's kind of a base price that's needed in the market before it starts to eat into profit margins. So going forward over the next couple of years, we would expect that as a base price. Over the longer term, as more supply continues to come online, that price will continue to trend down. Having said that, there will always be volatility, there will always be black swan events. And so I think it's needless to say that there's a strong likelihood that that price could go up again. But I think in Q4, we'll see a little bit of price surge because of Q4 seasonality in China. We tend to see EV sales go up. But if we're talking about severe volatility in the near or long term, we're not going to see anything like we saw in Q4 last year.
Phoebe, as we wrap up, Fastmarkets is always organizing amazing events. Maybe you can tell us what events are coming up in the next few months.
Yeah, we've got a ton. Our events team are incredibly busy. So first one is a webinar that my team are doing to kind of look at this year and look at the year ahead and try and dispel some of the chaos and explain to our clients what we're seeing for the near and long term. So I'd advise everybody to tune in for that. But in terms of physical events, we've got our China's Shanghai conference, December 6th and 7th. And then next year, we'll have our usual kind of lineup of our Asia conference in Seoul, which is super exciting. Going to be my first time there in May, June. And then we're going to go back to Vegas for our kind of flagship lithium event, which had over 1,000 delegates this year. So really, really excited to attend all of those. And anybody watching who wants to reach out or come, please do message me on LinkedIn or get in touch. It'd be really great to have you there.
Well, this is one of the great things about your job, Phoebe, is that you get to travel the world and meet many interesting people.
Best traveling I've ever done. I love it. Strongly advise working in the battery world.
Well, Phoebe, thank you very much for spending time with us today and sharing your insights on what's happening within the lithium-ion battery space. Once again, thank you.
Thanks so much, Jimmy. Always great to chat.
Stuart, Standard Lithium is involved in direct lithium extraction, or DLE, which is different from the hard rock mines we find in Australia or the brines that we find in South America. And I want to start right here with a brief discussion on DLE and the process and how it's different from other mining extraction processes.
You bet. Yeah, it's great to reconnect with you, James. Direct lithium extraction gets a lot of attention in the media from the lithium industry. It's a modern process. So as you highlighted, hard rock mining, I think we all understand how that works. Brine, lithium extraction from brine has been underway for basically 60 years using evaporation ponds. The challenge with evaporation ponds are large environmental footprints, low recoveries, and then the additional challenges that are required for permitting on building these projects, typically in remote regions. Additionally, a lot of lithium resources globally are not in areas where you have the meteorological conditions where you can evaporate the water to concentrate the brine. So the approach the industry is looking at and that we've taken is to use what the industry, as you said, direct lithium extraction, DLE, which is a process where you take brine and remove the lithium from that brine in virtually real time. And then you take the brine that you've released the lithium from, and then depending on the project, you return it to the source aquifer. So it's direct lithium extraction. There's a number of processes that are being trialed and developed in the industry that use adsorbents, ion exchange, solvent extraction. Each project defines which approach you would take when you develop a fully integrated direct lithium extraction process. So it's a process that the industry is evolving into on the brine side. It's not new. There are direct lithium extraction applications globally, several in China. Livent's project in Argentina, which has been operating for decades, uses a hybrid extraction process where they use direct lithium extraction and some conventional evaporation. So it's not new. It is required to unlock the resources that we're developing, and it's also being mandated, if you like, in certain regions where the evaporation pond and the expansions that are being looked at in Chile and other regions will have to investigate whether they can have a DLE process applied to those. So it's an evolution, if you like, in the lithium industry, sustainable, higher recoveries, and a higher purity final product.
Another element that makes Standard Lithium unique is its partnerships with Koch Industries and also Lanxess. And you already touched on Lanxess a little bit, but I want to examine these partnerships and how they benefit Standard Lithium.
Yeah, the application of direct lithium extraction, or DLE, is novel, and the region we're working in with lithium extraction is also it required some handholding with investors to demonstrate why it's so attractive from a company perspective. The opportunity to partner with Lanxess off of those existing infrastructures, 3 brine processing plants that produce between 4 and 5 billion gallons of brine annually to the surface, pipeline to facilities, chemistry, and then pipelined and re-injected, allows us to put our primary focus on that direct lithium extraction process, on how to define the most effective and tested process. So when we move from this demonstration scale work we've been doing for 3 years to commercial, we have been able to put the primary attention of capital and technical expertise on that process rather than focusing on the resource development and the infrastructure required for it. So that has been a unique benefit of working with Lanxess with that existing infrastructure. Additionally, first project we're proposing in South Arkansas, which we call 1A, ties into that infrastructure, removing many of the permitting challenges you face on a new project. Private property, so state level only permits. The reservoir management already managed because they've been doing this on these facilities for 60 years. So when we scale up a new process for investors, much of that project killers or project challenges that you face with infrastructure, permitting, social license, operational expertise have been managed. I wouldn't say eliminated, but managed so that we can focus on the core scale up, attention to that core scale up. Coke, they're a global business, star across numbers of different businesses from the energy sector, fertilizer, consumer goods, across numerous industries. They have a venture arm, investment arm that made a $100 million investment into Standard Lithium in 2021. That's not where that relationship ended. It didn't come with strings attached that we had to work with Coke, but they made an obvious candidate for us to investigate where we could benefit from their expertise. Coke Separation Solutions is their water treatment business. Coke Optimized Process Design is their EPC contracting business. Coke Minerals and Trading is a global minerals and trading company. And Coke Technology Solutions is applying processes and direct lithium extraction technologies into this ecosystem. So we've been able to benefit from all of those businesses, and then their attention on the direct lithium extraction aspect. We've been able to integrate process units that they've been developing into our start to finish DLE flow sheet. And as we've been doing that, along with developing our own proprietary processes, we've been able to work with a company that has great expertise, but also when we go to commercial development, by integrating some of these Coke process units, we can get certain performance warranties that you can't get as a startup company, where they can backstop that. Extremely attractive when we're trying something new. We've done the work to find the best process and have entire confidence in it, but where we can manage owners' liabilities and risks with a company of Coke stature and expertise across different processes, it just adds one more box that we paid attention to on how we manage scale up risk and project execution. Two tremendous partners that we're working with there.
Robert, you touched on the Project 1A, and you recently came out with a feasibility study on this project. Why don't you take us through the highlights of the economics of that study?
Yeah, the first project that we call 1A leverages that existing ecosystem or that existing infrastructure that I highlighted that Lanxess has at what we call their South plant. So we operate currently for the last, since 2020, a demonstration scale DLE plant to optimize and trial and test and train the operators the most effective DLE process. The scale up that we're looking to do is to take the demonstration plant, which takes a throughput of capacity at that from 50 gallons a minute, to take the full fire hose, if you like, of brine that operates at this facility at 3,000 gallons a minute. Around a 95% direct lithium extraction recovery through to final conversion of lithium carbonate, we're around just over 90 to 93%, gets us with the lithium grade in this resource to a project of operating 5,700 tons per annum of lithium carbonate initially, over a 25-year mine life, 5,400 tons. Not a world beater project, but it's a modest scale up where we manage that risk. The capital requirements for this are not massive like you'd find on many new projects where we're looking at multi-billion-dollar capex, $365 million. It is a modest project, so the capital intensity per ton is slightly higher, because when you're building something new and you don't benefit from those economies of scale, you have a slightly higher capital intensity, but the project economics are strong. Again, the region we're working with and that infrastructure is the reason we're doing this in a staged approach. The project economics are an NPV after tax of $550 million with an IRR of 24%. The operating costs are $6,800 over the life of the project, and that is really driven by the grade. What we're working on with this project is it's an existing plant. The lithium grades are high for North American standards, over the life of the project, the concentration is around 217, just under 220 milligrams per liter or parts per million. But it's an existing brine flow. Permits are straightforward. The path to go from where we are today, we're putting in place the project finance teams. We've got commercial arrangements that we need to work through with LANXESS on the operational aspect, brine supply and brine disposal agreements. But at the project level, we've defined and we've alerted the market to this. LANXESS has an opportunity to be a project partner at the equity side in the project company, and then also on the offtake side. So we're working through the steps of the commercial arrangements we currently have with LANXESS today. The intention on this project is to move through these steps, get to a final investment decision in 2024, followed by construction, and then commencement of production in 2026.
That's a good overview. Let's spend a little more time on the CapEx. You said it was 365 million, and I just want to spend some more time on how you would fund that.
Yeah, again, it is a modest project. Again, it's not an insignificant amount, but the majority of the project we're targeting through a debt facility. We've been working with BNP Paribas, who's one of the world's leading, if not top of the pile, in mining project debt finance. So we're working with them to put the pieces of the puzzle together. The completion of the definitive feasibility study has now allowed us into that next step. And we've identified a significant amount of interest in the project. And we'll be working with the lenders and their engineering teams to ensure that we have what will be required to be an attractive project for them. We're also actively working with our advisors on how we may benefit from policies coming out of Washington, specifically on this project in the Inflation Reduction Act, between 48C, which is an opportunity for a project credit or tax credit on the capital side, and then also on 45X, which is a manufacturing credit. So the completion of the definitive feasibility study is allowing us now, from the work that we've been doing in the background, to really accelerate so that we can look at non-dilutive opportunities through tax policies and put the best debt facility together, and then working through the commercial arrangements with LANXESS so we can define ownership of the project and offtake. And we've been extremely careful on ensuring that we've been putting the teams together and having the data so that we can move quickly, because within the definitive feasibility study that we completed and have announced, we also have a conversion mechanism within that to make that an LSTK, or a lump sum turnkey EPC contract. So again, where we work to manage and where we can provide more certainty on the project's capital requirements, on scheduling and certain price and engineering on the engineering side protections for our shareholders.
And OEMs have been very active in partnering with lithium producers and developers. Is this an option open to Standard Lithium? I know you made mention of the fact that you do have obligations with LANXESS, but is this still a possibility?
Yeah, the environment for offtake across OEMs, battery companies, and then additionally strategic interest at the project level is extremely high. I wouldn't call it a waiting list per se for the LANXESS project, but there's been a significant amount of interest expressed in all production. So with the LANXESS project, we have the commercial arrangements we're working through. On the larger Southwest Arkansas project, we completed a preliminary feasibility study in August of 2023. Much larger project targeting 30,000 tons at a base case of lithium hydroxide, 35,000 on an uppercase. That project is extremely attractive because it's domestic source of lithium hydroxide. I spend most of my time when I'm in Arkansas touring and hosting site visits from offtake parties interested in domestic supply. The attractiveness of having a domestic source of lithium hydroxide to qualify for the Inflation Reduction Act on EV tax credits is one important aspect, but the project's appeal also comes from working in a region where, as I mentioned earlier, that stakeholder support is unique. We don't face some of the challenges that some of our peers are having to navigate on permitting and other stakeholder engagements. And our environmental footprint by using a direct lithium extraction process is also much smaller. So you can demonstrate that you're not just securing supply, but you're securing it domestically on projects in a region where you have those benefits from sustainability, stakeholder support, and the project has a very clear path to move forward without some of the, there's always going to be challenges, but some of the uncertainty has been addressed. So that interest on both projects is extremely high. We're being thoughtful to our shareholders and then also to our project execution strategy so that we bring in partners that are complementary to both the ones we currently have and then also to our larger business development as we expand the projects and as we extend into Texas as well.
You just touched on your second project, which is called Southwest Arkansas. You recently came out with a pre-feasibility study on that project. Why don't you just take us through the highlights behind that study?
Again, so one of the unique aspects of how we're building these projects is the Southwest Arkansas brine grade is significantly higher than what we're starting with on the 1A project, double. We completed the pre-feasibility study, primarily moving the project forward, adding data points on the resource, because the extraction process that we're developing is applicable across the Smackover Formation. The chemistry is largely homogeneous. We don't have to reinvent the wheel at each project. We went into this pre-feasibility study with extremely high confidence and data points that we'd collected over the last 5 years, but we were really surprised with the drilling work where in areas we were expecting to confirm grades of 200 plus parts per million, we were seeing grades 400 and 500 plus. So the resource and our understanding of it was improved with that data, but it also showed a much more robust project than even our highest expectations were. The after-tax NPV, where we use our base case 30,000 ton per annum lithium hydroxide, is a $3.1 billion NPV project with a 32.8% IRR. Extremely attractive. The average lithium concentration on this project is 437 milligrams per liter or parts per million. That's what you see on projects in Argentina. Producing lithium hydroxide, the grade on any project is king. On direct lithium extraction, extremely important. If you can pump a unit of lithium, a unit of brine to the surface with 1 unit of lithium in it, and your cost is $1. If you can pump the same unit with double the amount of lithium in it, you almost have a linear cost savings. So grade is extremely important on DLE. On this project, our operating costs are just over $4,000 a ton for lithium hydroxide, just under $4,100 to be more, to round correctly on that. So extremely attractive. The upside case on this is a 35,000 ton per annum project. We'll be moving to selection of an engineering firm to begin FEED studies and definitive feasibility studies this year, 2023, and then moving into what we're hoping to be completion of those studies in the summer to Q3, Q4 of 2024. Extremely attractive economics on that project. And then recently, we also completed the acquisition of 118 acres of private property, which allows us optionality on locations for the conversion facility. Close to infrastructure, close to highway systems in areas, which is really important to highlight across the Smackover Formation, is we're in areas which are not under the same water stress that you find on a lot of the other lithium projects under development.
Robert, as we wrap up, you provided a lot of detail on your two projects, the Lanxess and the Southwest Arkansas project. But maybe you can just summarize for investors what they can expect in terms of news flow in the coming months.
Yeah, well, since we last spoke, it's also important to highlight, James, the project that we've been building and the attention that we put into the Arkansas Smackover Formation and the work we're doing in Texas is now starting to be validated by the entry of some of the world's biggest energy companies securing land positions, media reports that they're in Arkansas as well. They could have chosen anywhere on the planet. Additionally, our neighbor is between the Southwest Arkansas project and the Lanxess project is Albemarle, world's largest lithium producer, who operate bromine assets in South Arkansas. And now they've also begun paying attention in recent announcements that they're focusing on DLE, piloting work, Arkansas as an opportunity. So the region investors are going to get a lot more media attention on it. I've been banging the drum for 6 years, but these recent new entrants have amplified why we believe the region is so important. So with our projects, we put together a well thought out process. We're working as quickly on these projects as we can. We'd love to be able to work quicker, but the technical work needs to be done. Completion of the definitive feasibility study now puts us on the path towards moving towards the completion of the agreements with Lanxess so that we can get to construction targeting next year on that first project. Extremely exciting. I've been told by my team that expect the busiest 6 months of our career at Standard Lithium to date. So I prepped the family on that. On the larger Southwest Arkansas project, we'll be moving towards FEED and definitive feasibility study work, which will be mostly filling in more technical, geological, and hydraulic data. Additionally, the expansion work that we're doing in Texas. Spent a lot of time in Texas now, and we've got a very large team of landsmen and also on the technical, geological side, where we're looking to secure large lease packages where we've identified the most optimal brine conditions. So we'll be able to, once we've secured those leases, inform the market on the scale that we believe this region has to be the most important lithium producing region in North America.
Well, Robert, it sounds like you and your team have a very busy few months coming up, and I want to thank you for spending time with us today and providing an update on what's happening at Standard Lithium.
Thanks, James, and I look forward to keeping you informed over the next coming months as well.
Hi, Chris, and thank you very much for joining us today. Chris, when looking at where lithium comes from, jurisdiction is increasingly important. E3 Lithium operates in one of the best jurisdictions in the world, in Alberta, Canada, and the province of Alberta has a rich history in oil and gas, and this bodes well for E3 Lithium, given you will be using direct lithium extraction or DLE process. And these types of projects are very similar to oil and gas operations. And I want to start here, and maybe you can just start with the support that E3 Lithium has received from both the provincial and the federal governments in terms of funding.
Yeah, I think E3's been pretty fortunate. We've started off this project in Alberta, developing a direct extraction from a very famous aquifer called the Leduc. As everybody probably knows, Alberta is well known for its oil and gas industry, and there's a lot of parallels between how we operate and how an oil and gas company operates in the province on the conventional side. And so that synergy has prompted, I think, a lot of interest in developing a lithium industry in Alberta across the board, from government to industry, and mainly because, you know, to get a skilled worker in Calgary, whether you're in Calgary working at the head office, you're out in operating at a site, or anything in between, we have the skill set here in Alberta to do what we're trying to do. So it's a very small step to move from developing a oil and gas project to developing a lithium project. And I think for that reason, there's been a lot of interest from the federal and provincial governments to support this project. The provincial government has thrown some funding at it, but the biggest thing that we've seen is a couple of years ago, they brought into law a bill that brought the regulatory authority for lithium under the Alberta Energy Regulator, who regulates oil and gas. And that is fundamental to the ability for us to permit this project, because it has now a firm home in a regulatory environment that's well established, not just from a permitting perspective, but also a social license perspective. We will operate on private land. You'll see some farmers' fields behind me. That is our project area, and there's an ecosystem for working with the local farmers to put, for example, a well on their property. They get paid a little bit of money. That helps them out when the yields aren't as good, and there's a relationship there that is well established, and a respect between industry and the landowners. And that will dovetail very well into the lithium industry, because again, we operate very similarly. We will be doing the same sorts of activities. From the federal government perspective, there's been a big push from a geopolitical side to get local sources of lithium into the North American supply chain. The Canadian federal government and the US federal government have signed agreements to make that happen and to streamline processing and all of those other opportunities, including funding. So we've received $30 million from the federal government to develop this industry. And I think largely because of the ability to have a diversified industry, so we can produce lithium in Alberta, but also that we're the first. So we're cutting edge here of developing this industry, but there are others in the area in Western Canada trying to develop these projects. And the success for E3 means success most likely, therefore, for the rest of those companies and the industry across the province and in Saskatchewan as well.
You raised some very interesting points here, and one thing we cannot underestimate is the support of the public. And you mentioned, or you touched on, the social licensing, but because Alberta has such a strong history in oil and gas, you have the support of the people of Alberta with this project.
Yeah, and I think it's been a very important piece of where E3's come from. You know, all of our staff, save for one, have been hired out of Alberta's workforce. Everyone understands how to build and operate projects here in the province, and it's a little bit different than the mineral industry because this isn't really mining. You know, we're drilling wells and extracting a fluid in a closed loop system. So the impact to the environment from a surface perspective and from impacting like freshwater aquifers is very, very minimal. And especially when you look at how traditional lithium is produced. So I think those really bode well, because that environmental, which is dovetails very closely with your social license, because if you don't have an impact, the local communities are getting jobs, but they're not seeing an impact to the environment. And the combination of the two, I think, sets E3 ahead of most.
And I'm glad you brought this up. I want to delve into this a little bit different. And just as a reminder to our viewers, lithium is typically mined by traditional hard rock mining, which is what we have in Ontario or the province of Quebec, and also in Australia, where we have evaporation ponds that we find in Chile. But in Alberta, the extraction method will be using direct lithium extraction, or DLE. Maybe you can just expand on that a little bit more and what this process means.
Yeah, I mean, traditionally, lithium, before the lithium race for batteries, there was one hard rock mine in Australia, and lithium was produced as a byproduct in evaporation ponds. Since the advent of the lithium battery, and more so the commercial use of that battery in stationary storage, mostly electric vehicles and other applications, I mean, you can't find a battery now that's in a high power device that's not lithium. From your power tools to your scooters, everything is now using lithium. The reason is because it packs a large amount of energy density per weight, so you're able to put a small amount of power in a very small cell. And that has really changed the lithium industry, but there's not, looking at that industry from its infancy is really only about the past 10 years. While we produced lithium before that, we didn't need it in the quantity that we do in the future. So we're talking 3 million tons of lithium required in the next 10 years or so. We currently produce about 500,000 tons, a little bit less than that. So we have to scale this 6 times in the next 10 years. I mean, mining just doesn't, extractive industries just don't scale that quickly. You can build battery factories that quickly, but you can't build mines that quickly. And so when you look at it from the perspective of what we're doing, this chemical process to do the extraction of lithium enables us to expand and scale very rapidly. Because you drill the well, the product comes to the surface, and you're putting it through the system, and within hours you have a product at the back end. And that's a big differentiator between from the rest of the supply chain. The salars take a long time. Usually it's 12 to 24 months, depending on the salar and the rain, before you get the lithium into a product you can take to market. In a hard rock mine, most of them today, and I can't think of an example where this isn't the case, you mine it, you create a concentrate at the mine, and then it's transported for processing. The majority of lithium right now is coming out of Australia, about 55%. That's mostly processed in China. So it's put on a ship at port at 6% lithium, and then it's transported by ship to China where it's processed. And then from that perspective, 80% of the lithium we consume today, in terms of the battery quality lithium, comes out of China. And so having a local source here that is this big, I mean, one of the big advantages to E3's project is that we can scale this up to be a global size. 150,000 tons is our estimate, with a mine life of around 25 to 30 years. So it's a significant source of lithium that is local. We will produce the battery products directly out of the back of the facility. And all of that, for a company, enables us to grow and expand and become a global leader in producing lithium in a very stable jurisdiction.
So Chris, let's do a deeper dive on E3 Lithium. You and your team have achieved many milestones in 2023, beginning with the resource update. Can you touch on the highlights of that report and how this positions E3 Lithium's resource just in terms of size?
Yeah, absolutely. I think that resource upgrade was the result of a lot of work. We drilled some wells, we did some production testing to get an understanding of the aquifer, where we actually plan to locate the first facility. And that led to the upgrade of measured and indicated for a total of 16 million tons. And it's a significant size. It is a global size. There's, pardon me, not that many resources in one area that are bigger than this. And when you look at it from the perspective of Canada, the rest of Canada's measured and indicated resources total 3.2 million tons. So this is roughly about 5 times larger than all of the rest of Canada's resources combined. So it is a very significant size, but I think it goes to the size of the opportunity here in Alberta. I mean, Alberta does things big in the oil and gas industry. Everything that has happened in Alberta, it's always been global scale. You know, the 3rd largest reserves of oil are in the province globally. So we have the same geologic sort of system here, the same geologic stratigraphy that has enabled that same boasting from the oil and gas industry that we are now seeing from the lithium industry. We just have a very good stratigraphic package of rock that has lots of water in it in this one particular formation that happens to have lots of lithium. It's interesting because this aquifer started the oil rush in 1947 in Alberta when they discovered oil. And the oil has been produced off of it pretty much now completely. But even at that time, it was the majority of the fluid in there, by like 99%, was lithium enriched brine. The market has just changed, that's all, in terms of what we're interested in producing from it. So, I think that understanding and that size aspect, Alberta's well placed to capitalize on.
That's an interesting point. I didn't realize the oil and gas reserves were so large. Did you say number 3 in the world?
Yeah.
Interesting. Chris, another milestone was the operation of the pilot plant and the subsequent results. Can you provide an overview of this and the results, touching on the recoveries and also the impurities in the concentration?
Yeah, absolutely. I think the pilot was a very strong success for the company. We started it, constructing it in the spring, We got the thing operational in July. We are commissioning DLE in August, and have been running it since. We're just in the final phases of the first two systems that we tested right now, and the results that we put out for the first system that we tested, which are now public, demonstrated that we're able to produce a very high quality concentrate. So not just lithium grades, we take it from 75 to about 900, but the purity is also very, very high. So it's about 80%, which is important for the downstream. It allows you to simplify the processing. But I think what's most fundamental to this is the amount of brine they're able to flow. And we've given a ratio called the flow rate ratio, which is really the amount of brine you can flow per given amount of the chemical adsorbent. And what that's really talking about is the speed at which the lithium comes out of the brine. And if you can get the lithium out of the brine faster, you need less equipment. So your capital bill is smaller and your operating cost is smaller. And that is absolutely fundamental. And you would sacrifice that over the quality of the concentrate, and even in some part the concentration. So you want to have a high recovery. So the number one aspect is, I think, recovery. You want to see a high recovery because you have to take all the energy and effort to get the lithium molecule to the surface. You want to maximize that by getting the most lithium you can out of that is possible. So that is measured by the recovery. So seeing 94% recovery is very, very high. And then if you can do that at faster rates, which is what we were able to demonstrate, means we can build smaller equipment. So you get the same amount of lithium out, but you have to build smaller amount of equipment. And those will boast very well for us when we look to complete the economics for this project. The quality of the concentrate is a bonus. There's a lot of systems downstream of this because you further refine that lithium concentrate to something that becomes battery grade. So we would sacrifice a bit lower lithium in that and a bit less quality because you have to refine it anyway if you can reduce the size of your capital equipment for the process. And we've explained that in the news announcements that we've put out, that the real focus on this was that flow rate ratio and seeing that increase. And we've seen huge amount of increase than we anticipated. We anticipated a ratio of 3, and the results we put out for the third party are 9, and we're going to put ours out soon that are going to be even higher. So that fundamentally enables us with confidence to go forward and complete the pre-feasibility study that's currently underway.
Okay, I'm glad you brought that up. Let's talk about the pre-fees. What's the timeline associated with this?
Yeah, so it's currently underway right now. We're working with Bloor, as we've announced. It's likely that we'll be completing it internally by the end of this year, early next. Then we have to do the process of writing it into the standard NI 4301 format. So we're anticipating sometime in Q1 to have that published. And I think that's a big catalyst for us because it enables the movement forward in a lot of ways. It enables us to start the feasibility study. It enables us to start in earnest going to talk to potential partners to look for financing for this project and all of the other aspects that are important as 2024 for me and the corporate team will be more focused on how we're going to fund the development of this and looking at the project finance side. And you need that document as a critical piece to that so that we can get this thing shovel ready in 2025 and in operations by 2026.
So let's move on and touch on your finances and your balance sheet. How much cash do you currently have on hand and how will you allocate that in the coming year?
Yeah, so we've got about 40 million in cash in the bank right now. We also have about 20 million of unspent government grants that are still to come in. So we're at a working capital of about $60 million. The majority of that is going to be allocated to a couple of things. One, obviously moving into the feasibility study next year, doing all the engineering for that. That's pretty critical. We'll be staffing up a little bit to add a couple of project and process engineers to assist with that big task. And we're also contemplating doing some demo next year, and more details of that will come out to the market as we solidify those plans. to look at what that full process looks like operating that in Alberta. And then obviously some of the most important activity that's going to happen is as I've talked about some of the corporate activities, we're increasing our corporate team here at E3, adding some sophistication to it to go out and do a couple of things. One is look to find strategic partners to develop this project. We've built a very strong reputation in the industry of committing to things and getting them done, and I think that bodes well to find good partners that are willing to work with good companies to find offtake and other types of strategic arrangements. And that all leads us to a project financing that we'll be completing, working on through this next year. And then usually those wrap up once the feasibility study is out and the final sort of I's and T's get crossed post that. So, that takes us into 25 and then we can be shovel ready. So, next year is going to be very, very busy for us. 2023 was the catalyst year. The success of the pilot was fundamental. We're very excited to see that. The pre-feasibility though is the launching pad. We get that out, we get that going. The project from there just moves forward and we get more and more certain that we're going to start doing the all important thing that every company needs to do at some point, which is generate revenue. And I think that for us, getting this plant built and operating by 26 is a very strong goal.
And Chris, when you talk about strategic partners, I want to get a better sense of who that might be. Would that be other lithium producers or OEMs or what?
Yeah, I think we're open. I mean, at the end of the day, one of the definitives that we need are customers. And to get project financing, one of the critical aspects is to have offtake contracts, but this is what the industry does. This is standard course. Most of lithium today is sold under some direct sales contract. And so that's the number one goal ultimately is to find those customers. Through that though, the industry has seen more of a strategic relationship with those. I think they bode really well because things like qualification. So if you have a more of a direct relationship with your customer, that's not just a sales contract, that bodes well for your qualification, for getting the product into the batteries, for getting through that process, and working more closely with them on a day-to-day basis, and not just signing the contract and then delivering the product in 2026. And I think that is where the industry is going right now, because I think that the shortness of supply and that supply differential that the market is predicting, and it's just fundamental to the fact that it takes a lot longer to build a mine than it does a battery plant. And so being able to secure your supply to enable that your cars have lithium is fundamental to some of these companies. And it's not just OEMs, it's also the battery companies are looking at this very closely as well. And so, I think that E3 offers itself up as a good partner in a good, stable jurisdiction. We'll be able to supply securely the materials of need. And then looking at around the industry, I think there's lots of opportunities to talk to some other companies that aren't necessarily customers as well. There's a plant that needs to get built, and I think E3 is looking at opportunities to find those people that can help us out and get the certainty of this project. And the conversations are already well underway, but again, the launching pad for most of this is that pre-feasibility study.
So let's just summarize all of this for our viewers in terms of the path or the road to production. You mentioned you want to go into production by 2026. So what are the next steps in order to meet that objective?
Yeah, absolutely. So the next little while, we've got a bunch of news coming out about the success of the pilot. We'll be talking about, the downstream processing. Eventually we'll outline the technology that we plan to use for the first commercial plant, both for the DLE perspective, whether that's ours or third parties, as well as the downstream processing and all of that work to understand that. And it's a combination of those two pieces because they have to work together. That work is ongoing right now as the results from the pilot come in. We still have one more system that we're testing, so we're going to be waiting for that to come in before we make the final assessment. But all of the work is happening right now. I think that's very exciting because that locks a lot of things in. That certainty of that really drives us forward, because then the next step is to work with those companies to design a commercial plant. So take the data we've gathered from the pilot and design something commercially. And then we're looking at, as I mentioned, at a demo in 2024 as we do the engineering. And then we want to have the fees done sort of late 24, early 25. It's about the right time frame, 12 months from pre-fees to fees. And then, you know, it's project financing, it's detailed design, you're ordering equipment, things start showing up on site. You start constructing, you start drilling wells, and you know, you aim to be hopefully in operations before the end of 2026. So it's a lot of work, but it's how the company creates value. And if this one project, this one plant, the first plant is successful, you know, the real opportunity for E3 is 4 more of those. And that opportunity, when you look around at what we have in terms of, we got land in Saskatchewan, we've got the Rocky property we haven't looked at yet from any detail. I think there's a good opportunity for some M&A in the space as well. I think there's, you know, we have a good cash balance that can't be said for all of the DLE companies out there right now that are a bit further behind us trying to get their projects running. And I think there's some good opportunities. There's also a lot of interest in companies owning their own project, bigger companies in the space. And so I think there's lots and lots of opportunity for E3 to continue to create value, find creative and clever ways to finance ourselves and to build this company into becoming what the ultimate vision is over time, is a global lithium producer and supplying directly to the battery industry. So battery quality products, whether that be hydroxide as our first plant, carbonate, or even lithium metal in the future, is a big goal for E3.
Chris, as we wrap up, what can investors expect in terms of news flow in the coming weeks and months from E3 Lithium?
Yeah, I think, as I mentioned, still a lot of stuff coming out that solidify the plans of what E3 is up to. And I think what the investors can see from E3 is that the maturation that 2023 has enabled us to do is going to be outlined in its finality as we go through the next 4 months. So you're going to start to see a bunch of really strong announcements about technology providers and process paths forward. You know, obviously the pre-feasibility study, very exciting stuff all coming out. We're working on a bunch of corporate stuff that's harder to talk about that I think is equally exciting. So I think there's lots and lots happening at E3. And as I mentioned, we've got lots of capital at our disposal to deploy to do the right things. We're actually being very smart. We've always been good stewards of capital. We spend very little relative to our peers to get to the project to where we are today. And that will continue to move us forward as well as we look to develop this project and minimize the dilution for our shareholders, maximizing the value. And that's fundamental on everyone's minds here at E3.
Well, it sounds like you and your team are going to be very busy in the coming weeks and months, and I want to thank you very much for spending time with us today and providing a great overview of E3 Lithium.
Yeah, thanks for having me on today, James.
Hi, Howard. Thank you very much for joining us today. In addition to being an expert on battery metals, you're also well-versed in music, and you quite often make references to various rock and roll bands in your interviews and your research. And one of the greatest bands of all time, the Rolling Stones, just came out with a new album after 18 years. And I'm curious, what are your thoughts on this new album?
I've been listening to it while walking my dog pretty much every day for the past, since it came out. I think October 18th or 20th, it was on, it was on my calendar because I knew it was coming out, but they had released the single Angry Lithium ahead of time. And at the time that they released that single, I knew I was going to use that as a title for one of my lithium bulls. So our most recent newsletter is entitled Angry Lithium, the Rolling Stonks, to reflect the bear market that we're in, for lithium. But I would highly recommend soothing the pain that lithium investors may feel in their portfolio by listening to that entire album, and the highlight of which, in my opinion, is the one that Stevie Wonder and Lady Gaga are on, and that's the Sweet Sounds of Heaven. So I compared that to when will lithium nirvana, return, and we'll all be singing the sweet sounds of heaven. I don't know. I can't predict that. I don't know, but it will come. I'm confident it will come.
Well, I hope you're right, Howard. So let's move on and discuss battery metals. 2023 has been an interesting year for battery metals and lithium specifically. After being up 140% in 2022, spot lithium is down anywhere from 50 to 60% this year. I kind of lost count on where it is, but the spot market has been very volatile. And I want to start right here and get your views on what's been happening within the spot lithium market and why it's been so volatile.
It's a tough question that we are grappling with, and I'll caveat this by saying I listened to all the quarterly calls from the lithium producers, and what's clear from all of them is that no one really wants to predict the short term, right? And none of them predicted this downturn. So if the smartest actors in the sector who are analyzing the market, who are in it day to day, can't predict what's going to happen in the short term, or even the let's say even next year, who am I to give the right answer? But I'll try from what I know. And I'm sitting here in New York. My partner sits, Rodney Hooper is in Mauritius. We are reading as much as we can, but we don't have people sitting in China, and China is where all the information it dominates. So we Rodney called a bottom in around April, and there was a bounce into kind of June, and then it fell right back down, and now it's continued to go down. So it's unclear why, but we just think that there's been a destocking, right? There's been a lot of inventory last year. So there are supply reasons, and I guess there are demand reasons. So the demand reasons seem to be coming into play more now. You're seeing a lot of headlines about slowing EV from GM, and Ford, and Elon Musk was pretty dour on the quarterly call a couple of weeks ago, and high interest rates and wars and things like that. So there are, potentially some demand drivers impacting it now, but I think the supply reasons, there was a lot of buildup. There's a lot of buying last year, or maybe overbuying, and a lot of lithium is sitting inside cathode and inside cells, right? So there's inventory of lithium there, which meant that you didn't need to buy as much lithium, this year. So I think that's one component of it, but eventually that will be consumed, in battery, as cars are sold and other products are sold. The other avenue is that the very high prices incentivize all sorts of lithium supply that is not otherwise economic. The high end of the cost curve was profitable. So lepidolite in China, which is a very dirty and expensive way to make lithium chemicals, nevertheless, became profitable, and plenty of companies in China have started to make and process that. And that's why we don't have a great line of sight. I don't know how much supply of like the public companies, supply demand of hard rock and brine, we can get a handle on, but like how much lepidolite is available. Groups like Goldman Sachs and others have been warning about it, and they've been right, that there's been a fair bit of supply coming from lepidolite. And also another sort of black hole is Africa, and a lot of private companies that the Chinese are involved with, in Zimbabwe, Nigeria. We're learning now about a lot of this supply, and a lot of it is just direct shipped ore. It's not even processed. Some of it's processed, but we saw this last cycle that in China you have a lot of conversion capacity. All through the pandemic, they continued to build conversion capacity, and China has the skills to process all sorts of lithium inputs. So I mean, they've been developing this industry for a very long period of time. It doesn't just have to be 6% spodumene concentrate. If you look that the grade has gone down. Typically, in the last down cycle, it had to be 5.7%, 5.8%. Now the average grade is like 5.3%. That's the average grade. Mineral Resources average grade out of Mount Marion was like 3.7%. So even like 1%, lithium, direct ship ore from Africa, they know how to process and will process in China. But how much of that supply has come combined with the lepidolite over the summer? You also have the China brines, production volumes, are higher. You've also had supply from new suppliers in the spodumene market, Core Lithium, Ciampaglia and Piedmont through North America Lithium, Sigma Lithium in Brazil. These are new units that have come into the market of spodumene, and you've had ramp-ups, brownfield expansions from Greenbushes has had more supply, Mineral Resources through Wodgina has had more supply, Pilbara has ramped up production. So there's been a fair bit of supply. The demand has been growing. I forget exactly what the overall size of the market is today, but whatever, 800,000, 900,000 tons. But the price has come down because spodumene is a commodity. Lithium, despite what others may say about specialty commodity focus, I mean, it's still it's highly prone to the whims of supply and demand. What I just said was there's a lot of cross currents here, and I don't really know the answer, but this is my synthesis of the current cross currents.
And do you think we found a level somewhere between $20,000 to $30,000 a ton?
I hope so. My partner Rodney is more the analyst than me. I say he's a CFA, buy side analyst. He's a real analyst. I just play one on YouTube. Is kind of like I joke. So he believes that like 20,000 is kind of like a floor, or it's very difficult for the high cost, the high end of the cost curve to make money at that price. That doesn't mean that you can't see lower than $20,000 prices for periods of time. That there are times when producers will operate at a loss, as we saw in the last down cycle. But the price should not go down to $5,000 or $6,000 as it did in the last down cycle, because the costs have gone up so much, right? We have had inflation, and so he thinks 20,000 is like, and 1,000 spodumene. A number of players won't make money at 1,000 spodumene, right? So he thinks it needs to be higher than that. His long-term assumption, I think, is about 2,000 spodumene and around 30,000. But at the current market environment, he thinks like 20 or so is a floor. You say, are we finding a level between 20 and 30? At 30, you'll make meaningful money, right? At 20, much less so. So that's a reasonable range. And right now we're like at 22, if I saw like the last Fastmarkets number.
So that's a great overview of what's happening within the lithium sector. I want to also get your thoughts on graphite. I know you don't cover this, or this is not an area of expertise, but as you know, China recently imposed restrictions on graphite exports. It's a very critical component of EV batteries, and I wanted to get your thoughts on this, and what does this also mean for the lithium sector, if anything at all?
I'll answer the question on the lithium side. It doesn't necessarily mean anything today, but it is a warning, right? That if they did this for graphite, they could do it for lithium. And if you're reliant on lithium and there's not ex-China supply of lithium, you'd be in trouble, right? And so that's the only corollary for lithium. Graphite specifically, we looked at graphite for a number of years. Nouveau Monde, was a client of ours for a period of time. It's not now. Last year, we were trying to get our head around graphite. And a problem with graphite is, unlike lithium, there's no Albemarle and Livent and Allchem and SQM in the graphite sector. That is, publicly traded companies who educate the market every quarter about what's happening in the graphite market, right? It's completely like China dominated. right? You have Syra, one company that, is producing, but it's not, they're not a huge player. And the market for graphite is bigger than lithium, and there's and the EV component of it is much smaller, right? So the steel industry, so you have to analyze like so much, in the graphite market, but it is more dominated by China than anything. Another factor is there's the synthetic graphite versus natural graphite, and what's the preference, but China very specifically, this is a big pinch point, right? China does control all of this, and if they are, I don't exactly know what the restrictions are specifically, but it just sounds like it's another warning shot, just like they did with gallium and one other one in rare earth space. It's just a reminder to the world that being overly reliant on China for any kind of critical material is not a good thing. And it's why America's Inflation Reduction Act and other policies are being implemented on a global basis to change that. But it's going to take a really long time. But the graphite plays like Nouveau Monde and others are touting this. See, finally, we got some good news, on graphite, because the graphite price has been going down also a ton this year because there's oversupply. Why is there oversupply in graphite? I don't know. So yeah, I don't know much more about graphite. Will we have, uranium? I know you've been focused on uranium. Finally, is having a great year after many false starts. Is this a false start for graphite, or is this like, okay, graphite will be the next uranium, into 2024? I'm watching it, but it's very complicated industry to analyze, and it's not going to get easier. It's very opaque, and anyway, it's also a very difficult thing. We've seen this in the past. If the one lever is, China turning on or off a commodity, right? It's very hard to get excited about the commodity because they're turning it off, and then a year from now, 2 years from now, all of a sudden they turn it back on and they crush the price, right? So I'd like to have a better, fundamental understanding of like supply and demand on graphite and synthetic, natural, and it's very complicated. Benchmark Minerals does, I think, a very good job, as good a job as anyone can in deeply understanding, the graphite market. But I'm not convinced that this news is going to turn graphite into a hot uranium market, but it could. And I'll let the stocks kind of tell me what's going on.
Howard, I want to get your views on both strategic investments and also M&A within the lithium sector. And this has been an ongoing theme in 2023. Albemarle made a strategic investment in Patriot Metals. General Motors made a very large investment into Lithium Americas. And even with this pullback, do you think this theme is going to continue into 2024?
I do. I think it should accelerate. I think Albemarle is going to be looking for other things, right? Possibly in Australia, but possibly more in Canada, possibly in Brazil. I'll say, and you mentioned General Motors and you mentioned Stellantis. General Motors and Lithium Americas, that was for Thacker Pass, a clay project. Stellantis and Control Thermal. What we're noticing is that the incumbents, Albemarle, SQM, those who know the business the best are buying spodumene resources in Australia. Outsiders from the industry who have a big vested interest don't seem to be doing that. They're going for unconventional flow sheets. So they're taking on some added risk, in doing that. So that's just something I would say. I mean, Ford, in fairness, did have a $300 million debt facility into Liontown. So Ford has spread things around. They have some hard rock. They have some, I think they're looking for offtake from Compass Minerals and, in Utah. But Tesla has only done hard rock, right? And Tesla is building a hydroxide facility, to be fed by hard rock principally. So yes, I think we're going to see more M&A. I would love to see Tesla actually write a check, not just get offtake. But LG Chem, they wrote a check into Piedmont, for 200,000 tons of spodumene over 4 years. So I think you're going to see more battery companies, maybe SK, Samsung. Will we see Panasonic? I don't know. Toyota has written, Toyota Tsusho has done some. So absolutely, there's been so much news and deal flow. You're going to see it. But the current game is in Western Australia with iron ore billionaires. I've been talking about this. Life is good and life in the fast lane, LIFE, excuse me, taking a cue from the Eagles. So life in the fast lane, is Gina Reinhardt. I put out a tweet. I forget exactly the lyrics, but she has a nasty reputation, as a cruel dude. Said she was ruthless, said she was crude. So, here she is thwarting Albemarle, and she might be thwarting SQM. But overall, she's invested maybe $1.25 billion, $1.5 billion in on-market purchases to block these companies. But she generated, $5 billion just last quarter or in the first half, or some crazy number. Like, she's making so much money in iron ore through Roy Hill that it's a very interesting dynamic. It's a rough and tumble, entrepreneurial patriots, in Western Australia that kind of was saying, hey, foreigners, this is our turf, right? But you have her and Mineral Resources, Chris Ellison, who are kind of, carving out, the Western Australian spodumene dynamic, which is the most important dynamic in the lithium space. It's the Australia to China relationship and is very strong. And there are new discoveries being made all the time. However bad the lithium price is going down, there's been a huge activity in exploration companies. Azure came out of nowhere. And if you were invested in Azure, you would have made, 10, 20 times your money. So that side of the, like, even in this bear market, Rodney and I are very focused on early stage exploration, in particular in spodumene plays. And not just in Western Australia, but what has also become, you mentioned Patriot, the hottest area, one of the hottest areas in lithium is James Bay, Quebec, after Quebec being, the bastard child of the lithium industry with the prior failures of Nemaska and North American Lithium. But North American Lithium's restart, has put Quebec back on the map, and Patriot and Winsome, exploration success. I think you're going to see more of that. I think you're going to see more strategic interest come to Canada, with Quebec, at the top of the list. Maybe Ontario, maybe some other jurisdictions, provinces, and I think you're going to start seeing them come into Brazil as well, because there have been meaningful projects that have discovered resources, and in Sigma's case, there's in production.
You made a lot of interesting points here. I guess one of the things I want to ask you about is why SQM and also Albemarle, why not focus on South America? Why did they go to Australia, and why haven't they come to Canada yet? Well, Albemarle did make an investment in Patriot, but there's many other companies.
So South America, SQM has a challenged relationship with their country, their government, and policy matters. And Boric, is changing policy in Chile. So I think what's interesting is that Lithium Power International, which is a former client of RK Equity, a very advanced permitted brine in Chile, right? Very high grade, very high quality, is basically being sold not to SQM, right, but to Codelco, the state, copper company, for like $300 million. So you're seeing SQM is paying for the equivalent. Like Azure as a company is 40% owned by Mark Creasy. So like when you buy Azure, you're only getting 60% of the asset. I think, I forget exactly, their bid was like 1.4 or 1.5 billion, but for 100% of that project, it's effectively $2.5 billion or thereabouts. So they're spending that money on a company that doesn't even have a resource yet. It's going to be many, many, many years into the future, where they could have just bought Lithium Power in their Maracunga asset like for $300 million. So why is SQM not buying that, right? Because there was only one bidder for Lithium Power, and that was Codelco, right? Because the government policy, so good assets go cheap if government policy is bad, and the government, doesn't like it. In my opinion, Chile's pain, is Australia's gain, and will also be Canada's gain. And I think Albemarle looks the same way. Albemarle has struggled to ramp up production. Also, brines are hard. Okay, brines are hard. They take a long time, right? Lithium Americas is just starting to be in production with Ganfeng, which is like 7 or 8 years after Orocobre, okay, or Allchem. And they started at the same time. So there's lots of projects in Argentina, but brines take a long time. Political risk in Argentina is high. And that's why I think you're seeing the incumbents who have existing customers that, Hard Rock is more scalable, it is sustainable, it's secure, I have these 6 S's. It's just, Western Australia is a great jurisdiction. You can get permitted there. There's a skill set of people who can do things there. In Argentina, they're very remote areas, very high altitude. It's very, it could rain a lot one year and then it messes up. Brines are just, they're a challenge. They're low cost. Fundamentally, if you get it all right, they'll be low cost, but they're big headache. And so I think that's the reason, but if I saw something different, if I saw all of a sudden that they were buying into Argentina, then, maybe there would be a rush into Argentine assets again. Rio Tinto kind of came in. There, a number of players did go into, Argentina, but I think China will be there, right? China is okay. They act, yes, they want to make profits, but security of supply matters, and I think China will be more comfortable with the evolving rules in Chile than a Western actor like Albemarle, and then SQM, just through Julio Ponce, et cetera, has a challenged relationship with the government, and they're negotiating, a long-term, update to their, I think their lease expires in 2030. And this investment in Azure, to me, is a tell that those negotiations aren't necessarily going too well.
And do you think it's just a matter of time before SQM gets involved in a Canadian asset? Yes, I think it's just a matter of time. But we have some intelligence, from that they were looking seriously, this year, but weren't going to make an investment this year, right? But next year they might, right? Or the year after they might. But they were very astute. They found Azure early, and got 19.9%, quite early at a low price. So the average, to get the rest is, will be lower, but the price that they're paying, this 2.5 billion or whatever the number is approximately, is orders of magnitude larger than what they paid to get into their Mount Holland asset, which they're partnered with Wesfarmers on. They basically invested $150 million to get 50% of that project. They have had to invest a lot more now, obviously, to build the mine and the hydroxide plant, but just the cost of entry to get control of the asset in 2017
was much cheaper than what they have to pay now. So the fact that they're paying as much as they're paying now, reflects their optimism on the long-term lithium fundamentals. So that's a good sign. It represents that negotiations aren't going so well in Chile, in my opinion. And it represents that they want to be in hard rock. They don't want to be in clay. They don't want to be in DLE brine. And they don't want to be in South America. If you remember, they came into Lithium Americas in Argentina and then they left, right? So they're not, the Chilean Argentines, they're not interested, right? But it will make sense for them, as the North American and European markets evolve. They're not going to want to just, they can't just process in China, right? Hard rock from Australia, right? And I don't know, maybe we'll see. They're building a hydroxide plant in, with West Farmers that's taking a really long time. I think they're struggling with it. SQM doesn't really have hard rock mining skills they in a meaningful way. They've had to learn spodumene concentration skills, and that's hard in its own right. And then learning to process from the hard rock to hydroxide, in Western Australia, that Albemarle has struggled, with Kemerton. Tangshi has struggled with Kwinana. So, but they recognize the market's growing very fast, and they want rock. They want hard rock. So, so that would make sense that they would want to come to Quebec, in time. So I wouldn't be surprised if you start seeing SQM do what they did with Azure, maybe find a company and buy a 19.9% stake, that's focused in Canada. And I would bet it would be in Quebec first.
Because we're on the subject of M&A, I want to ask you about Exxon and Chevron. They recently made very large acquisitions, 50 billion plus, which is like the entire size of the whole lithium sector. But do you ever envision seeing an energy company investing or buying a lithium company?
Yes, and you've seen there were rumors or talks that Exxon had bought a private company, Galvanic, which is in the Arkansas region, DLE story, for like $100 million. E3 Lithium received a $5 million investment from Imperial Oil, which is a subsidiary of Exxon. So, and Koch is in the oil business, and they have invested in Standard Lithium, $100 million, and they invested in Compass, $250 million. So I think the oil and gas companies are more comfortable with liquid lithium, right? So these oil field brines. I think Exxon should buy Albemarle, right? Because in the past, Albemarle traded at a very high multiple, like 10, 12, 15 times EV to EBITDA, where the oil companies are trading at 5 or 6 times. So it would not be accretive on that multiple basis. But now the multiple of Albemarle has fallen so much that it probably would be accretive. And they're in the chemical business, the refining business. So it would make sense. But the fact that big oil is merging with itself shows two things. On the one hand, it shows they believe fossil fuels have a future, for a long time. On the other hand, it could be a reflection of like, well, it's going to be a declining industry overall, and we now need to be bigger, right? And rather than spend a ton of money on exploring for new finds, it's cheaper to buy existing. So it's, I don't view it as necessarily a negative to the lithium space, but I'm not confident that we're going to see big oil into the space. I thought we'd be seeing more big mining into the space, and I think we will. I think Rio Tinto has made some, small investments in Quebec on an exploration side. I think they have a bit of buyer's remorse. They spent $825 million on Rincon in Argentina, and they're realizing that's, going to be a challenge. But why Rio Tinto hasn't played in, the Western Australian market, that's their backyard. I've thought for years that they could have. I think they were late, to some degree, but or they could have gotten really, like in the last downturn, they could have picked up assets for almost nothing. Now they're looking at the market and they're saying, oh, valuations are too expensive, they're too frothy, whatever. So they're watching and waiting. But I think valuation now is a great time for them to enter and try to pick up some assets, like high quality assets like Albemarle or Livent. Once that merger is done with Allchem at the end of this year, could be interesting to them. Simon Moores at Benchmark Minerals made a comment that, like, with the lithium prices down so much, there's like a 6 to 9 month window now where the OEMs, auto OEMs, battery OEMs who have been, reluctant because prices were so high, they should now pounce, while the price is low, and start cutting deals and writing checks to a number of these development companies. But with GM and like Tesla just doesn't seem to want to write checks. Everyone I'm speaking to is telling me they haven't gotten there that they're going to write checks for upstream mining. And GM, yes, they wrote a check. Half of their check went to Lithium Americas, but on the other hand, now they're slowing down their EV investment. Is all of this kind of negativity that the UAW, strike has raised their operating costs, will raise their operating costs, and they're not making money on EVs. So are they going to rush to secure supply? It's hard to see. Like, I'd like to see GM finalize their investment with Lithium Americas, and I hope they do. And when and if they do, maybe others will follow. But big oil, I think, I don't know, we'll see.
Very interesting points, Howard. As we wrap up, we began this discussion talking about music, and I'm going to end it the same way. I see a verse from a very well-known song behind you, behind your left shoulder. What's the significance of that?
So Bob Marley, Three Little Birds, Don't Worry About a Thing, because every little thing is going to be all right, is actually my ringtone. And when I saw this, I don't remember exactly where I found it, but I figured I had to have it. And I'm in my kitchen, which I'm usually podcasting in my guest house, which has a different background, but I sometimes interview from here. But this is where I do all my Zoom calls. So whenever I'm having someone here, rather than have a fake background, it's just a subliminal message here, and it's a subliminal message to all your viewers who are invested in lithium that don't worry about a thing, because every little thing will be all right in due course. I hope it'll be in 2024, but if not, after that. The long-term thesis for lithium is still very much intact. Be selective, maybe speculate on some early stage juniors, because like I get comfort from SQM and Albemarle and Gina Reinhart and Chris Ellison writing big checks based on the long-term thesis.
Well, that was a great discussion, and that's a great way to wrap it up. And I want to thank you very much for providing your insights today and making time. Thank you.
Thanks very much for having me, Jimmy. A real pleasure.
Well, that concludes the conference, and we thank you for taking the time to be with us. We have some amazing conferences coming up, so be sure to subscribe to our YouTube channel, Bloor Street Capital, and hit the notification button so you can always stay up to date with future events. Thanks again for your support.